as it happens. Bloomberg Business Week Daily with Carol Masser and Tim Stenovec, live on Bloomberg Radio, television, YouTube, and Bloomberg Originals.
And a very good afternoon, everyone, live on Bloomberg TV, radio, and Bloomberg Originals. This is Bloomberg Business Week. Carol Masser along with Tim Stenovec, and no doubt about it, folks, the Sell America trade, it is on.
Yeah, we're just off our worst levels of the day, down 3.34% on the S&P 500. You said stocks are selling off, Carol. The U.S. dollar is down, and long-dated treasuries are also lower.
All right, and so no doubt about it, this hour, we are all in on market. And President Trump's verbal attacks on Fed Chair Jay Powell, that seems to be one of the latest factors in the depression that we are seeing, certainly across U.S. assets. So we're going to dig into that in just a moment.
Also, how a Supreme Court move could destabilize markets and harm the U.S. economy and potentially allow Trump to remove the Fed chair or other Fed officials at any time. This is certainly on our radar this week.
We are certainly living in uncertain and interesting times. All right, we're going to get to that over the next 60 minutes and more. First up, though, let's get a check on the trade. We welcome back Charlie Pellet.
Hi, thank you very much. And here's what's going on. Just another manic Monday and not a fun day for the bulls. With the Dow, the S&P, and NASDAQ at or near session lows right now. We've got the S&P 500 index tumbling as President Trump continues to verbally attack Fed Chair Jay Powell, calling on Powell to cut rates as signs mount that the president's trade war is pushing the economy toward recession. Right now, we have got the S&P 500 index lower by 178 points, down 3.4%. Again, lows of the day on the S&P right now at 5104. The Dow down 1,276, a decline there of 3.3%, while the NASDAQ Composite Index down almost 600 now, down 595, a decline of 3.6%. 10-year at 4.39%, the 2-year 3.73%. Gold is surging 2.9% to a record $34.23, up $96 the ounce. West Texas Intermediate crude 63.20 a barrel, down 2.3%, and Bitcoin at 86,730. Bitcoin up by 1.9%. Nvidia shares are trading lower, trading near the lowest valuation of the AI era, but a growing list of perils has investors cautious about taking advantage of the dip. Nvidia now lower by 6.3%. And President Trump set to meet with major retailers at the White House as business executives seek relief from sweeping tariffs that have destabilized global supply chains and rattled American consumers. Recapping fast-moving markets to the downside today with the S&P tumbling 179, down 3.4%. Keep it locked into Bloomberg Television and Radio to find out how things shake out at the closing bell and beyond. For on-demand news 24 hours a day, subscribe to Bloomberg News Now wherever you get your podcasts. I'm Charlie Pellet. That is a Bloomberg Business Flash.
All right, Charlie, thank you so much. All right, folks, we have seen this movie before. Stocks tumbling here in the United States as President Trump continued to verbally attack Jerome Powell, calling on the Fed chair to cut rates as signs mount that the president's trade war is pushing the economy toward recession. As Tim mentioned at the top of the broadcast, dollar falling with long-dated treasuries as well. So let's get into it and let's look at today's trade, what's going on. Back with us is Bloomberg News Senior Editor, Equities Americas, Eric Weiner, right here in studio. All right, Eric, so walk through the moves because it's been pretty much a straight line down for the most part. We've all seen worse selling, but walk through the numbers, how it's going, the volume, and what it looks like to you.
Sure. It actually kind of started Friday, I would say, or Thursday, I would say, when late in the day when Trump made the comments about Powell and the threats. And the market doesn't like to hear that. They really actually like Powell. So that started selling. And then as we came in this morning, it was just downward pressure. The thing is that volume is extremely light. And what we're hearing from investors and traders is that it's the most orderly 3.5% down day that they've seen.
So just no worries.
No worries. But
Sarcasm.
what seems to be, so the issue is that it's just steady selling. And that's what they're all like. There's about 16 stocks up on in the S&P 500, and all of the pressure is on going down. We've lost about 10% in the S&P 500 since the tariff announcement. That includes a big updraft on one day, but it's just been this hammering of pressure and questioning growth, questioning what's going to happen, the negotiations with Japan, the conversations with retailers. None of this is reassuring to the market.
I want to get to the conversations with retailers in just a minute, but there is one place that is moving higher, and that's gold. And that has been on a steady drumbeat higher. And earlier today, it was like the only area of green that I could find when I looked at assets. Is this just fear?
Yes.
Something, to be fair, some crypto too, but and we could get to that. But I want to kind of keep it to that. It's hard to explain crypto, I think.
People find their homes, but gold is obviously, where you go when you're looking for solid value, actually tangible value, physically tangible. I can hold it in my hands value. And that is like the classic play when you're seeing all of this pressure. So yeah, gold prices are going up. It's a strange time because interest rates aren't, like, bonds aren't behaving as places that you would necessarily store your value. The currency, the dollar, isn't acting that way either. So if you're a bear, if you're really concerned right now, you're in gold.
I am curious too, in terms of, do you look at it all together against what happened in Asia overnight, what happened in Europe overnight, and what happened in the United States? Because it does seem like increasingly this is becoming a very targeted bunch of selling.
It is. Now, it's hard to say today. Right. It's hard to say today because a lot of Europe was off for Easter Monday.
Good point.
So that's, we think, kind of where some of the volume coming off is coming from. We're not sure. We'll find out later. But yes, the idea seems to be that if the U.S. is not going to be the place where you can store value and count on it staying at least stable, then where do you go? And there are any number of places where you can go to find return. I mean, emerging markets are doing actually quite well right now. So there are places that you can go for return, but do you trust if the global economy is going to go down as hard as some of the predictions are, then there's really no place to hide. And that's the thing. And then you hear lines from China where they're saying, bring it on. And that scares everybody because you're talking about something that's much more prolonged. And I think what Wall Street, this is all speculation about, what Wall Street in general wants, but certainty would be it. Give us what you want with the tariffs. Tell us what you want with these other countries. Let's get the negotiations going. You want to fire Powell? Fire him, for God's sake, and let us trade through it. But the
seriously, they're like,
well, that one is,
because I am curious what you're hearing. Like, this is where Tim and I love to go to, like, the Markets Live blog and see what you got, like everything that's coming in. Is the mood like, all right, just take care of these things so we kind of know what we're dealing with?
Well,
or is it a case of if that happens, then we've got some really serious trouble?
That's the flip side of this. So Powell's the one where it's like, it's a little bit different. But there is this element of, I know how to trade through this. Like, I know what to do. It's the uncertainty and the constant badgering. So if you know that, like, let's say they're going to fire Powell, and that's going to take, 6 months to sort out and whatever else, you just kind of want to get that going. You don't want to have to, sit through day after day after day of this.
Maybe, but at the same time, there are folks who've shared with us there would be big concern about the independence of a central bank if the president got directly involved here. And that is a much bigger issue for the structural integrity of how we see the economy.
That's absolutely right. And that's why nobody would take that for granted. And the idea, look, there are examples going back to Nixon of them yelling at the Fed chair. So it's not new for presidents to sort of badger the Fed chair, even in private. But this public constant hammering and the language that they use, calling him an idiot or whatever it was, it's just, it doesn't give people confidence. Now, when you're talking about the Fed, you're talking about the ultimate confidence machine. Like, that is something that we all have to believe in. You have to believe that it's making decisions based
It's
not...
the central bank that everybody wants to have around
It's
the world.
It's everybody's central bank.
Right?
It's
Yeah,
exactly
right.
it. So in effect, it's a central bank for the world, and you need to know that it's actually acting that way.
That's why I wonder, like, if indeed they're like, okay, let's just get it done, get them rid of it. But then you're talking about, like Tim said, a structural, fundamental change potentially in the United States.
No, nobody. I don't think anybody wants to see Powell gone. That's
I know one person who does.
Yeah, I would correct that.
It seems like one person does.
Yeah, okay, not everybody, but
lives in a big White House.
Everybody X that, and I think that they've warned him about that.
Let's bring Kathy Jones into the conversation because she's another great voice on all of this. Eric's going to stay with us. Kathy Jones is Chief Fixed Income Strategist at Schwab Center for Financial Research. She's out there in Miami. Kathy, I assume you've been listening. Once again, we have an environment where stocks are down, long-dated treasuries aren't trading maybe how we think they should in a risky, volatile market environment, and we're concerned about maybe what could happen in terms of the U.S. Central Bank and the independence of the Fed. What are the conversations you guys are having with your team?
Yeah, we're trying to figure out, well, first of all, it's very difficult to know what's going to happen tomorrow or actually 10 minutes from now. So it is difficult to map out a strategy because, you want to start with an investment thesis, move to a strategy, and have some tactical ideas. And the problem is that the investment thesis is muddled by all of these issues that don't seem to go away but don't get resolved. So the tariff issues, we have no deals yet. Everyone's waiting for the deals. There are no deals to speak of, and it doesn't appear like there's any on the horizon. And then you have the threat to the independence of the central bank, which is existential, that is fundamental. And that's why you're seeing bonds underperform, do poorly, why you're seeing the dollar plunge. And this is a problem because it isn't a fixable, easy crisis to walk in and say, okay, this hedge fund blew up, they need liquidity, or the banking system needs money or needs shoring up here or there. This is more at the heart of governance and the independence of the central bank, and that's not easily fixable.
Well, Kathy, in your view, what would it take for bonds to start doing what bonds are supposed to do in a stock market that's declining? What has to change, or what has to be known?
Well, I think what needs to be known is that we're going to leave the central bank to be independent, first and foremost, to do what it sees as the right thing to do. So get off Powell's case. And, whether you like Powell or not, it doesn't matter. Just hands off the central bank. That's important. And the second thing is to have an economic policy, frankly, that ties together, right? So we have tariffs that raise inflation and push down growth. We have now a fiscal policy that looks like it's going to be expansive. And all of these competing factors don't add up to something that you can look to and say, okay, this makes sense. So we need to get all these things to tie together and have a path forward. If we tip into recession, we need to know that the Fed can ease and that rates will actually go down rather than go up, because there are worries about fueling inflation by losing independence of the central bank. So got a lot of stitching back together to be done.
Eric Weiner here. We're hearing that there may be some kind of a lift-off if and when there are some tariff deals. Is that because there's suddenly some certainty in where we're going? Is that something that you guys are hearing, looking at, or anything along those lines?
Well, we've heard the same stuff. We've heard the same comments that, well, all we need to do is get some deals and then we'll say this was all negotiating tactics and we can move forward from there, because we'd have at least a map, right? We'd have a roadmap to say, okay, it's 10% across the board and we can calculate what that means for the economy and maybe for inflation and Fed policy. So I think it would be helpful if we got some deals, but one of my colleagues was pointing out today that traditionally, trade deals take anywhere from 18 months to 3 years to finish up. So this is not usually something that's done in, a snap of fingers. There's a lot of things to work out with our trading partners. So the idea that we're just suddenly going to get a deal, I mean, maybe it will happen, but traditionally that's not how trade negotiations progress.
Yeah, it takes a long time, right? And the clock is ticking, certainly on the market environment. Kathy, I agree with you. I think get some tariff deals, even if they take a while to get done, if we see some constructive moves forward, that would be a positive sign to investors that, okay, they're working it through. If we did get a situation where the Fed chair is removed, even if there's some legal wrangling back and forth, it's a new game, right?
Yeah, that's a major change. I mean, people count on the U.S. in particular as a place where rule of law prevails. And we've had presidents in the past who have tried to do things. I think it was Roosevelt who was trying to stack some of these committees with people who would be more to his liking than he thought that was at the time, but it didn't succeed because of the rule of law. So that's important to maintain that, because if you lose central bank independence, you've really lost the credibility that backs the dollar, backs the treasury bonds, et cetera.
Would it make the U.S. uninvestable?
I don't know, totally uninvestable, but it certainly would take a lot of shine off of U.S. assets. And, what we're seeing now is real money assets leaving too. This is not just highly leveraged people blowing up.
What specifically are you seeing in that in terms of real asset?
We're seeing asset allocation shift, gradually, not suddenly, but gradually. The yen is going up.
Yeah.
Euro is going up relative to the dollar. We're seeing investment flows move. A lot of the money that's come in over the last couple of years has come in from households in other countries as well as households here. Well, that money has started, the latest data we have, which is still pretty old, but that data is showing that money's shifting away. So it isn't just the fast money moving here, it's real flows.
Eric, in your view, and based on the folks you speak to, the reporting that you've done, in your view, do you think the market is taking seriously where it is right now, that the president could succeed in pressuring Powell in some way, whether that is a resignation, whether there could be a decision that allows the president to do something?
I don't think they think that he'll do it. I think that, in all honesty, I don't think they think that he'll do it. I do think they think that he won't stop talking about it. And in a lot of ways, that can be as disruptive, obviously not as disruptive as actually getting rid of him, but you're talking about
just
the person that the market
today.
trusts.
Yeah.
This is the face of it. And you remove him or you start threatening him, and Wall Street suddenly says, who are you working for? And that's really where, the rest of the world looks at this and says, what are you doing?
What do you think, Kathy, on this specifically? Do you think that what the reaction that we're seeing in the market has fully priced in what the president could do?
Well, I don't think it's fully priced in. I would agree with Eric that the market thinks he'll continue to talk about this and to push for it, but I don't think the market's fully discounted the possibility that it could actually happen. And, partly because Powell has pushed back a number of times, and we do know Powell's an attorney. I'm guessing he's already looked into this and has his playbook for what he would do if this were attempted. There's also a lot of other people on that committee, so you probably have to replace, 6 or 7 people to get the policy that you want.
Right.
So, it isn't going to be easy if he's going to try to do it. And frankly, there's not even that much time left in Powell's term. So,
that's a good point.
Picking this fight in many ways just doesn't make any sense, because this is all going to play itself out, in less than a year. Why not let it play itself out?
This is actually something that we've been talking about on our desk, which is that it's 2026 when his term is up. He also was appointed by Trump. The question when he came on was, would he keep him? because he's so popular with Wall Street. The idea was like, you know, you can't get rid of Powell. This guy speaks for the market and the market trusts him. So I think that any turn away from him actually does some form of damage. Even the conversation about somebody else taking over doesn't give Wall Street and the market confidence about where this is headed.
Well, and it also speaks to presidential power in terms of changing things, perhaps at a whim, some might say. Hey, Kathy, U.S. Treasury Secretary Scott Bessent, is everyone hoping that he is in some ways the guardrail around all of this?
Well, that certainly was the thought process coming into this administration. I'm not sure that people are as confident now as they were before, just because some of his comments have been around things like, well, you know, that process of vetting new candidates is going to begin very soon or something like that. And I think people feel like if he had a lot of influence over this, he probably would have already discouraged talking about it publicly and wouldn't be suggesting, hey, we're already looking at new candidates. And then you have Hassett coming out and saying, well, you know, we're kind of considering this thing. So maybe it's just a lack of communication, but I don't think Bessent is living up to the expectations right now on the communications front that Wall Street had of him.
Kathy, Carol asked about guardrails, and when I hear guardrail, I think, wait a second, maybe the bond market has already been a guardrail to some of these policies in the sense of the 90-day pause that we heard from the president close to 2 weeks ago. We did hear the president actually reference the bond market, saying it got, quote, a little yippy, and he was watching that. How did you view that as somebody who looks closely at fixed income? Do you think the bond market has the power that it's supposed to have?
Yeah, I think so. You know, and I think that did demonstrate that the bond market pushed back hard enough that it altered behavior. And I think it would do so again. I mean, 10 years around 440 today. And we start getting back to 450, 460, you know, threaten another run at 5%. And I do think that, that would cause the White House to dial back some of the verbiage. But I don't know. Yeah, how many times can you do this and have it be credible? You know, how many times can the bond market get yippy before?
Right. Or are you constantly on pins and needles that even if there's some resolution, do you think, okay, well, wait a minute, does potentially, you know, the president just change his mind, right? So, I mean, I don't know. Do you anticipate whatever this is and however this perhaps cycle in terms of news from the president and the White House and markets, even if it resolves itself, are we kind of on pins and needles for the rest of the tenure of his term?
I would say that, yeah. I mean, the president is a lot less predictable than, you know, most presidents have been. In the past, the administration has many voices out there speaking in many different ways. And the policies are less conventional. And so people can't just look through the verbiage and say, oh, well, this policy is like something we're familiar with. The policies are very different. I mean, this is really an attempt to reorder the economy away from free trade towards a more closed economy. And that's a huge undertaking. And I think that the market will always, will continue to be somewhat on pins and needles, knowing that, at any moment things could change.
Well, I'm on pins and needles, Eric, because earlier in our conversation, you mentioned this meeting with retail chiefs at the White House. We got news today that Walmart and Target executives are set to meet Trump as this tariff angst is spreading. I was a little surprised not to see some movement higher in the equity market as a result of this news. Perhaps it shows the way that the Fed chair concerns are overshadowing everything. But is there optimism that something like this could lead to exemption? You're shaking your head.
No.
Before I'm even done with the question.
Well, no, the problem with that meeting is that he's meeting with the people at the end. So these are the stores that are going to sell the goods that are going to be more expensive. What is he going to say? Don't raise the prices. They're going to say, our retail, our sales are going to get hit, our earnings are going to be challenging, and it's all because of the stuff that's coming in is more expensive because of the way that you've affected the supply chain. So talking to Target, talking to Walmart, they can voice their concerns, but it doesn't really get to the production end of things, which is they're going to deal with goods coming in that are priced higher, and they have to sell it to people, and either it's not going to work and their sales are going to go down, or prices are going to go up, and we're going to see a big spike in inflation.
Right, that's just the way it's got to.
Yeah.
It's either. Or. Hey, Kathy, really quick, 20 seconds. So, what do you do in the fixed income market? Where do you go? Just quickly.
We are up in quality and staying at benchmark or below in duration. Just playing it real cautious right now. And with the exception of municipal bonds, they look really good and they're somewhat removed from all of this. And the yields are very attractive if you're a long-term investor.
There's always an opportunity somewhere in the markets. We know that. Both of you, thank you so much. Kathy Jones, Chief Fixed Income Strategist over at Schwab Center for Financial Research, and of course our big thanks to Bloomberg News Senior Editor of Equities Americas, Eric Weiner.
Hey, let's get an update on the trade as we continue to see stocks in the red today. Let's get on over to Charlie Pellet with an update. Hey there, Charlie.
Hi, thank you very much, Tim and Carol. Resetting here. We've got the Dow Jones Industrial Average falling below 38,000, 37,908 right now, down 1,233 points. For the Dow, that represents a drop right now of just about 3.2%. Stocks are tumbling as President Trump continues to verbally attack Jay Powell, calling on the Federal Reserve Chair to cut rates as signs mount that the president's trade war is pushing the economy toward recession. We've got the Dow, as I mentioned, down 3.2%, the S&P down 3.3%, falling 172 points to 5109. NASDAQ now lower by 3.5%. 10-year 4.39%, with the 2-year 3.73%. Spot gold up $95 the ounce, trading at a record $34.23, up 2.9%, and West Texas Intermediate crude down 2.7%, $62.95 a barrel on WTI. Tesla shares now down 7.1%. Tesla will be the next big earnings event for U.S. markets after the close of trading tomorrow. For on-demand news 24 hours a day, subscribe to Bloomberg News Now wherever you get your podcasts. I'm Charlie Pelleton. That is a Bloomberg Business Flash.
All right, Charlie, thank you so much. As we've been saying, the Sell America trade definitely gathering some momentum. Charlie, of course, just breaking down the numbers. Concern President Trump will act upon his threat of firing Fed Chair Jay Powell, implement policies then that could lead to a recession. President Trump reiterated his call for the Fed to reduce rates earlier today on Truth Social, writing, preemptive cuts in interest rates are being called for by many. That, again, Tim, of course, is President Trump's words.
Well, let's get to it. With us is Bloomberg News economics editor Molly Smith. She joins us here in the studio. Also with us is Columbia Law School Associate Professor of Law Lev Menard, joining us from New York. Molly, I do want to start with you. In your world, how serious is it, with economists and the like talking what feels like a threat by President Trump against the independence of the Federal Reserve?
I mean, it's definitely a serious consideration right now, and the way that Trump just keeps going after Powell day after day in all of these different tweets, whether people are taking seriously this idea of preemptive cuts, quote, being discussed by many, that is definitely refutable and not at all being priced in. I mean, there's a roughly 16% chance right now, looking at the Bloomberg Warp screen, of a rate cut in May, which is coming in a week or two. So no one's really thinking about that happening right now. And if rate cuts are to happen, people are saying that's because the economy is going to slow because of Trump's policies, not because inflation is slowing, like he claims.
Yeah.
Exactly.
Okay.
Professor Menard, come on in on all of this. The Supreme Court considering a petition from the president that could allow him to override some legislation establishing independent agencies such as the Fed and remove their leaders without cause or notice. What exactly is this case about? Why are we talking about it, especially since this case does not involve any Fed officials? And why is it, though, potentially so significant for the Fed, for Fed governors, and perhaps other heads of different organizations in the government?
So the Fed is one of many independent agencies in the government, and its 7-member board enjoy the same sort of protection from at-will removal by the president as other agencies, like the Federal Trade Commission, the National Labor Relations Board. And President Trump, in his few months in office so far, has already challenged the laws protecting these officials from removal at pleasure by the president. And those challenges. He removed several officials illegally. Those challenges are making their way through the courts right now, and the Supreme Court of the United States is currently considering a petition from the government, from Trump, to allow him to push these officials out of office until their cases make their way through the whole courts, which could be months and months. And that petition could be decided this week. And if Trump were to prevail, then he could go ahead potentially and fire the whole Fed board, not just Chair Powell, as soon as this week. And those officials, if they wanted to challenge those removals, would be out of a job during the pendency of the litigation.
Professor Menan, given what you know about the case, what you know about the arguments and the history, and of course the justices as well, do you have a prediction what is likely to happen if the Supreme Court rules one way or the other?
It's really hard to say, but based on the last segment, I think markets are really not pricing in the risk here. So already we have an administrative stay issued by Chief Justice Roberts in this case, Trump v. Wilcox, last week, which meant that Wilcox, who had been put back in her job at the NLRB by the lower courts, was taken out of her job while the Supreme Court considers President Trump's emergency application. That suggests to me that there are many members of the court who might consider granting this stay pending appeal on an ongoing basis. I think that there are members of the court who have expressed in prior cases real reservations about allowing the expansion of presidential power to touch the Fed. There's a desire to carve out a Fed exception, but the more uncertainty there is in this space, the more likely we would see President Trump potentially testing the boundaries. And so that might not mean a removal of Chair Powell, but it could mean a removal of Governor Barr, Governor Cook, in the coming weeks.
Whatever happened to checks and balances, Professor Menan? I'm just curious. We always just thought this government, how incredible, right? 3 separate branches, checks and balances. Are you, as someone who teaches, who studies, and the power of the Supreme Court, like, are we losing that? Have we lost it?
We are very much losing checks and balances. This is not a new thing. This is the culmination of 40 plus years of efforts to reconceptualize the presidency under the Constitution in such a way that Congress's laws attempting to constrain presidential power can be violated by the president. And Ronald Reagan was the first, really, to push this in 1981 when he took office, and there was a Democratic House, and there had been a Democratic House as long as anybody could remember. Reagan administration officials sought to assert presidential authority under the Constitution to do certain things that they didn't have the votes for in Congress. Those moves were ultimately embraced by the Clinton White House, and we've had a sort of ever-expanding conception that the Supreme Court has validated at several points, starting in 2010 with the Roberts Court decision in a case called Free Enterprise, which restricted the ability of Congress to protect the independence of the PCAOB, the board within the SEC that regulates accountants. We had a series of cases that validated more and more this once fringe sort of constitutional theory of the presidency. And now we have President Trump in his second term trying to do a full bear hug of this sort of this presidentialist theory. It's called unitary executive theory. And that is very inconsistent with traditional checks and balances.
Just to expand on this idea of checks and balances, it's not so much one that's afforded by the law and the different branches of government, but just within the Fed, something that I don't think we speak about enough with respect to who makes decisions on interest rates is that the chair of the Fed does not act similarly to the president of the United States. They don't have executive power to just unilaterally make a decision for the entire Federal Open Market Committee, which is comprised of 12 members, which includes the 6 governors on the board, which, Powell is one of those people. And to what the professor was just saying, that if Trump were to remove Powell, then that would also then set a precedent. Is he going to go after all these other governors? But again, this is a decision that on interest rates It's set by this whole committee. It is not just by one person. And there would be some real credibility concerns if new people were to come in, that all of these other people who are on the board, or on the committee rather, who have been advocating for keeping interest rates steady, are they really just going to go along with this new person just because Powell was fired?
Look, I understand why the president wants interest rates to be lower. He has a background in real estate. He likes low rates. He's, we talked about this in the past. But Carol, I would think that a leader of a country would want a strong, independent Federal Reserve because of the confidence it gives markets and because of the way that historically the U.S. has been looked at as Eric just told us, the central bank for the entire world.
Gold standard, like in terms of the U.S. central bank. And I do think about this, Molly, that if it's not just the Fed chair, but goes after the other Fed governors, that's a whole new ballgame, just quickly.
Yeah, of course. I mean, we're talking about half of the Federal Open Market Committee right there if he goes after all those other people. So,
right.
And again, all of them are, I mean, the thing though that I guess maybe gives me some confidence is that no one is calling for these preemptive rate cuts. I don't know what economist Trump is going to find who is calling for that right now.
But it also plays into the game of instability if we constantly see this kind of movement.
Sure.
Both of you, thank you so much. Professor Lev Manan, thank you. Columbia Law School Associate Professor of Law joining us, along with our Bloomberg News Economics Editor, Molly Smith, right here in studio. Coming up, how one real estate investor is dealing with all of this.
It's 2:40 on Wall Street. We do check markets all day long here at Bloomberg. Back to work Monday, and we got a sell-off underway. Very close to session lows right now with the Dow, the S&P, NASDAQ all in the red. Stocks are tumbling as President Trump continues to verbally attack Fed Chair Jay Powell. Right now, the S&P 500 index trading at 5117, a drop now of 3.1%. The S&P is down 167 points, very close to session lows. The Dow is down 1,182 points, down 3%. NASDAQ is down 562, a drop there of 3.5%. The 10-year at 4.38% with a 2-year that is currently yielding 3.73%. Gold up $98 the ounce, up 3%, $34.25. And West Texas Intermediate crude down 2.2%, $63.25 for a barrel of WTI. Bitcoin at 86,943 for Bitcoin. That is a gain of 2.2%, now up by $1,843. Sources tell Bloomberg Air India is looking to take Boeing planes that were rejected by Chinese carriers, joining the ranks of Asian airlines vying to benefit from the trade war between Washington and Beijing. Boeing shares, they're down now by 2.7%. So again, recapping, the Dow, the S&P, and NASDAQ all lower. S&P right now down 3.2%. For on-demand news 24 hours a day, subscribe to Bloomberg News Now wherever you get your podcasts. I'm Charlie Pelleton. That is a Bloomberg Business Flash.
All right, Charlie, thanks so much for that update. As Charlie mentioned, we're just kind of bouncing along the bottom here when it comes to the equity trade, so we'll keep an eye on that. Hey, wanted to mention something from our Bloomberg Intelligence team. They put out some research that notes that U.S. multifamily housing starts were flat in the month of March, so kind of making it difficult to determine any long-term trend. Permits, meantime, rising. Both metrics, though, they write, appear range-bound well below the 2022-2023 peaks and relatively consistent with kind of going back to 2017-2019. Research goes on, but it makes the point that developers are less eager to build more than they were post-pandemic. Our next guest knows a lot about this.
I want to bring back Thomas Carroll, founder and CEO at the RIA Ballast Rock Asset Management, and invests in multifamily real estate properties and in venture capital. He joins us from Boca Raton, Florida. The investment environment that we're seeing right now, since we last spoke to you a few months ago, when it comes to a lot of U.S. assets, a lot has shifted. In your world, though, has anything shifted?
Yes, I think a lot has shifted. It's all to do with uncertainty. With the equity market as a barometer for confidence, shaky confidence leads to uncertainty, and uncertainty makes it really difficult to position for any long-term or medium-term investment decision like real estate.
What are you uncertain about, though? Because last time we spoke to you, and the time before that and the time before that, you were bullish on certain areas of the country. You talked about migration patterns. You talked about the need for housing in these areas. That's not something that you've seen shift at all, has it?
No, but what we have seen shift is uncertainty around the cost of capital, both equity and debt. I think that's the kind of primary driver of uncertainty at this time. Additionally, though, as a direct result of tariffs, the imported components of construction have become materially more expensive. And additionally, you've yet to determine how much, but there will be a direct result on reducing labor supply through enhanced migration and immigration enforcement as we see that filter through the economy.
All right, Thomas, this sounds pretty dire. If you've got uncertainty around the cost of capital on both the equity and debt side, and then you're also worried about higher costs
fewer employees to build the things that you want to build.
Exactly. Another component, right? So are projects being put on hold, being stopped completely? Is it just everybody's waiting for, okay, we know things are going to probably cost more. Let's wait until we understand really what the cost of debt and equity are, and then we can start to reprice projects. Is that where we need to get to? Like, give me an idea of how you're thinking this plays out.
Well, so we think we have a pretty good understanding as to the changing cost of the components of construction. Mm-hmm. And in fact, a few of the key factors have been exempted from tariffs, or at least the tariffs have been stalled or delayed around those. So, for example, Canadian imported soft lumber, Mexican imported gypsum for drywall, concrete, and nearshore appliances. So there have been certain specific exemptions. So that piece of it, I think, is easier to understand and quantify. The more challenging piece is the labor component and the cost of debt capital in particular. And has it stalled construction? Absolutely. That's why at the outset of this conversation, you raised the expectation of lower delivery of multifamily units this year, 2024. 2025, excuse me. We're already forecasting substantially reduced deliveries next year and likely for the years to come. And that's really after the Fed liftoff in March of 2022. You've seen a reduction of the amount of expected development. That's great, though, for those of us that are long real estate. So it's dire for those that are looking to develop. It's dire for those that are looking to buy new homes or rent. But for those of us that own a portfolio of rental real estate, it's not so dire.
Right. Kudos to you. But the component that you said that if you're looking to rent or buy, well, we are so close to getting inflation to the Fed's target, there is concerns that puts prices for real estate back up again, and it just increases some of the inflation components that are out there, correct?
Absolutely agree, Carol. And shelter, as you know, is a very significant component of CPI. It's between a third and 45%, depending on your definition and measurement. So it is a very material, has the potential to very materially contribute to CPI, and the knock-on effect that the Fed needs to make with regards to balancing a potential stagflationary environment with, or at least at a minimum, a reduction in growth against their need to combat one-off inflation from the self-inflicted wound of tariffs.
Thomas, can you talk a little bit more about what you're seeing in the labor market right now? What's happening?
So we don't directly hire anyone that doesn't have all the appropriate paperwork and et cetera. But we have heard from our subcontractors, that it's become materially more difficult to hire some of the labor that they're required to hire. So we haven't seen it directly, but we have seen indirectly a lack of supply of labor in an already constrained labor market.
Right, especially in a segment that many people argued for the last few years has been challenging given lack of a pipeline here in the U.S. when it goes into skilled trades, no?
Absolutely. And I mean, the National Association of Home Builders has already shown that the cost of housing of a single family home has gone up about 34% since December of 2020. In our prior labor environment, a large part of that is labor cost increases. And so in a tighter labor environment, I think there is the potential for substantial further heightening of inflation on the labor component of development.
And just to throw another scenario in there, Thomas, I mean, there's always what could help the labor market, what could help prices for people who are looking to rent is, of course, an economic downturn or a recession. And yes, I'm being sarcastic. But I mean, how likely is that scenario as you watch everything continue to unfold?
Well, as I've read it from the large firms' economists, they're generally specifying, or they're highlighting that the potential for GDP growth in 2025 has been reduced by as much as 1%. Given the volatility driven by a variety of different economic policies under this administration. So does that put us into recession territory? Unclear. I think at the moment, we think it's unlikely this year, but I think there's a heightened potential for recession in the next 18 to 24 months. And we're positioning as an organization around that. We've actually had a strong leasing season so far.
Interesting.
Leasing. Yeah. However, how that changes over the next 24 months or 18 months is hard to tell at this time.
You were a perfect voice to talk to on this Monday, so thanks so much for carving out some time for us. Thomas Carroll, he's founder and CEO of the registered investment advisor Ballast Rock Asset Management, joining us there from Boca Raton, Florida. Folks, we've got a market where we are down 174 points on the S&P 500, down 3.3% and down about 3.5% on the NASDAQ 100. When we come back, some of the stocks on the move on this Monday.
This is Bloomberg Business Week Daily with Carol Masser and Tim Stenivek on Bloomberg Radio and Television.
All right, folks, we are looking at a market that is bouncing around.
Is it up yet?
It's not up.
Not, okay.
But it's not necessarily taking another leg down.
No,
bouncing around our lows of the session, so down 3.3% on the S&P 500, 177 points lower. Dow Jones Industrial Average down about 3.25%, down 1,260 points. NASDAQ 100, we know all of those tech-heavy names reside 3.6% to the downside, and that's looking at a decline of about 662 points.
Hey, we also have a lot of earnings on the horizon. We're in the midst of earnings season. We're going to be speaking with Gina Martin Adams in a few minutes on Bloomberg Business Week Daily as our show continues in just a bit. And I know I have a lot of questions for her about what we're going to hear from these companies and how that could change or confirm the narrative.
Yeah, I wonder if that turns things around. All right, let's get to some of the stocks on the move. With us is Natalia Kanijeva. She is Bloomberg News equities reporter here in studio. Natalia, let's take a look at some of the stocks on the move. And I am curious, most of the names are down today, but you found a few gainers. But where do you want to start?
Yeah, so it's really hard to find any advancers today. But let's start with Sweetgreen. There are lots of corporate stories, of course. So, for example, on Thursday, after the close, the company said that COO will transition to a consulting role. She's leaving basically the company, but she will stay as a consultant up until June 1st. Separately, of course, there are lots of macro headwinds. So, for example, Bank of America downgraded the stock. They said that demand will be under pressure, of course, as we have lots of tariffs.
I love
and there's
sweet
also
green.
It is very popular.
I love sweet green.
Okay, but you're not leaving in the middle of the day to go get your lunch. I know that about you.
I eat from the food court.
Yes.
Here. Bag of peanuts usually.
But what's the concern about demand? Is this some sort of I'm not going to say recession indicator. We're talking sweet green here after all.
Right.
But is it some sort of commentary on what the market looks like in the locations that sweet green operates in?
Yeah, I think it's also fair to look at locations just across the country, not just New York. But for example, analysts noted that demand was, of course, hurt by weather. We have wildfires in Los Angeles. This is one of the factors. And then, of course, tariffs, uncertainty. The company also itself said that stricter immigration policies can potentially present a headwind for the company. So lots of different aspects, and of course that could increase.
For workers or for goods, like in terms
it's
of
just the costs of doing business. Potentially they should shift or adjust somehow their labor participation forces.
And look, I think it's important to note here, it's not that companies, and I'm not speaking for Sweet Green here, I'm speaking generally, but I think one concern, Carol, that people have about this is that even if you don't hire people who are undocumented, you're still going to feel the effects of a shift in the labor force if there are fewer undocumented folks to take roles that they typically did. So then you're competing for employees with every role.
Just a tighter workforce overall. Yeah, kind of interesting, right? And what is the stock down? I just was curious.
It's down by almost 50% on a year-to-date basis.
Yeah, almost 50% year-to-date. Wow.
Exactly.
Yeah, and it's got almost a 20% of the outstanding shares are being shorted of the float. So really, really negative tone.
Okay, Sweet Green, Amazon's also on your radar today. What's going on with Amazon?
Right. So we got another downgrade from Raymond James, and analysts are saying that earnings will come under pressure from increasing investments, and of course, tariffs is another headwind.
Yeah.
So they are saying that potentially, yes, China is also a big factor because lots of supplies are coming from China. So it also one of the biggest unknowns. So there are two main components. There is a retail, and there's also AI, spending on AI infrastructure. And we got a note just recently from Wells Fargo, and they say that industry sources pointed to a pause in deals for Amazon Web Services. So this is another headwind again. We will see how this plays out, and of course, earnings is in big focus.
Okay, let's go to some happy news.
Depends on who you are.
Let's go to something that's up today.
Yes, so we do see that.
It's one of my gainers.
I don't want to be the bearer of bad news, but a couple of these stocks were higher and then moved lower, Carol. So
I know.
I'm be on guard. Okay?
I think this one's holding on to it. Go ahead.
Exactly. So Discover Financial Services is up by 3%. This was maybe still is one of the best performers in the S&P 500 index. So overall, this
number one gainer.
Great, yeah, even better. So it wasn't a huge surprise, that Capital One is acquiring the company. People expected a little bit lighter regulation.
Yeah.
Now the biggest question, what comes next, and people are saying that Capital One is basically a lender. It issues credit cards, MasterCard branded, and potentially it will transition those issuance to Discover Financial. It can create more competition in the space. Then earnings, of course, they haven't reported yet, but we will be looking for any commentary on that. And then from the flows perspective, it was really interesting for me to see that hedge funds returned as big buyers of banks, regional banks as well.
And by the way, Capital One was the one that was down about 0.8% at one point today, but as high as 5.3%.
Yeah, which is
be
interesting.
Careful with that one, Carol.
No, I know. But Discover definitely. But I think there's anticipation, maybe more consolidation even, whatever's left there. Natalia, thank you so much. Natalia Kenijevic, she's Bloomberg News equities reporter right here in studio. All right, for those who are watching on TV, the close is coming your way as we get ready for the last hour of trading. Coming your way in just a moment. Tim and I continuing on Business Week, watching these markets. Gina Martin Adams going to weigh in. We're going to talk earnings, the outlook. What's next? This is Bloomberg.
CBS News on the Hour, sponsored by O'Reilly Auto Parts.
I'm Cammie McCormick. Pope Francis died this morning, and the Vatican now says he suffered a stroke. Millions are in mourning. CBS Papal contributor Delia Gallagher has been talking to some of the mourners at St. Peter's Square.
Pope Francis touched people from all over the world. His authenticity, people spoke to me about. The fact that he often spoke out in favor of the poor, in favor of immigrants.
Despite his poor health, the Pope appeared in public just yesterday with an Easter blessing. Reporter Rich Lamb.
Nobody was really expecting it, and especially the Monday after Easter. You know, it seemed that Pope Francis virtually willed himself to live through the Easter holiday weekend with its message of resurrection after death.
Correspondent Chris Livesay on what comes next at the Vatican.
His body will be placed in a coffin. He's then going to lie in state for about 4 to 6 days, at which point he will be buried. There's a 9-day period of mourning, which has just begun. And then, of course, there is the conclave, when cardinals from all around the world descend on Rome to elect the next pope.
In this country, President Trump ordered flags flown at half-staff in honor of the Pope. The president today defended Defense Secretary Pete Hegseth after reports of another signal chat on airstrikes in Yemen. This one included his wife and brother. Both Hegseth and Trump blamed the media.
This is the same old stuff from the media. That's an old one. Try finding something new.
The new U.S. ambassador to Israel is calling on Hamas to accept a deal that would secure the release of hostages in exchange for humanitarian aid being allowed into Gaza again. In Russia, President Vladimir Putin signed new laws today, further strengthening a crackdown on dissent as his war on Ukraine enters its 4th year. One law makes it a criminal offense to discredit the army or call for sanctions against Russia. A Ukrainian delegation has now arrived in London for the latest peace talks. The markets have been off all day, partly because of new tariff threats by China, but also because of the president's pressure on the Fed chair. Here's business reporter Jason Brooks.
President Trump's latest salvo at Fed Chair Jerome Powell calls Powell Mr. Too Late when it comes to cutting interest rates and calls the Fed chief a major loser. Powell has been targeted by the president after Powell said the tariffs will fuel higher inflation and slow economic growth, and the lack of concrete trade progress continues to unnerve the market.
And checking the numbers on Wall Street at this hour, the Dow is down 1,200 points. This is CBS News. Music's faded in the California desert, but concert goers are still talking about the stars. Deborah Rodriguez reports.
Coachella is a wrap after Ed Sheeran made his surprise debut on the second weekend of the music festival in Southern California's Colorado desert. Lady Gaga ran into a mic malfunction during her performance of her new hit, Abracadabra. Gaga later apologized to the crowd, explaining, quote, "At least you know I sing live." Deborah Rodriguez, CBS News.
Scientists say a newly discovered green comet has likely broken apart and won't be visible to the naked eye. It's called Swan, and it's far beyond Pluto. It's been visible through telescopes and even binoculars for the past few weeks, but experts now say it probably did not survive its trip past the sun. This is CBS News.
This is Bloomberg Business Week Daily, reporting from the magazine that helps global leaders stay ahead, with insight on the people, companies, and trends shaping today's complex economy, plus global business, finance, and tech news as it happens. Bloomberg Business Week Daily with Carol Masser and Tim Stenivek, live on Bloomberg Radio, television, YouTube, and Bloomberg Originals.
All right, everybody, we are less than an hour away from the closing bell on this Monday, April 21st, and we are looking at stocks just rounding off their worst levels of the session, but it's still more than 3% declines on those major equity averages. We're going to talk about the markets with our Gina Martin-Adams, see what she has to say about the trends that she is seeing and maybe where we go from here.
Yeah, we're also going global on the concerns about the world economy, what's happening in the U.S., and where you can hide. In addition to Gina joining us, we're going to have Stuart Paul and Curran, all coming up in just a few minutes.
By the way, there's nowhere to hide if you look at the S&P 500.
Gina has an idea.
Under a rock?
No.
Under your bed?
It's outside of the U.S. That's the hint I'll give, okay?
All right, we're going to talk about that in just a moment. And we're going to get into a couple of great stories on the Bloomberg. Max Chafkin out with an exclusive on the architect behind Trump's presidency, and then also another individual who really turned Donald Trump onto podcasts.
Yeah, he's a YouTube manager.
Love this story.
Sarah Fryer's going to be joining us a little later in the program. All that and more coming up over the next 2 hours right here on Bloomberg Business Week Daily. First up, though, a check of the day's trade and top business stories. Here he is, Charlie Pellet.
Hi, thank you very much. Indeed, a quality hour coming up on Bloomberg Business Week Daily with the Dow, the S&P, NASDAQ, very much in the red. Got to keep it locked into Bloomberg Radio to see how things shake out right at the close. And, of course, beyond, we'll keep you posted on Asian markets this evening. But right now, we got the S&P down 167, down 3.2%. The S&P now at 5115, with the Dow down 1,216, drop there of 3.1%. NASDAQ down 550 now, a decline of 3.4%. The 10-year 4.40%, the 2-year 3.74%. Gold is surging $102 the ounce to $34.29. For gold, that is an advance now of 3.1% at a record. West Texas Intermediate crude down 1.9%, 63.48 for a barrel of WTI. As for tariffs, markets, and the backdrop, Kathy Jones is chief fixed income strategist at Charles Schwab, and she was a guest last hour right here on Bloomberg Business Week Daily.
Everyone's waiting for the deals. There are no deals to speak of, and it doesn't appear like there's any on the horizon. And then you have the threat to the independence of the central bank, which is existential, that is fundamental, and that's why you're seeing bonds underperform, do poorly, why you're seeing the dollar plunge.
Kathy Jones of Charles Schwab, the 10-year again, 4.40%, with the S&P down by 3.2%. Uber is being sued by the Federal Trade Commission, which claims the rideshare and delivery company hurt consumers through deceptive billing and cancellation practices as part of its flagship subscription service. Uber down by 4% now. Rival Lyft, both based in San Francisco, down 2.9%. For on-demand news 24 hours a day, subscribe to Bloomberg News Now wherever you get your podcasts. I'm Charlie Pellet, and that is a Bloomberg Business Flash.
Thanks so much for that update, Charlie Pellet. Really do appreciate it. Well, we heard the numbers from Charlie, but worth repeating. Off our worst levels of the day, but the S&P 500 still down 3.2%. We're also seeing longer-dated treasuries join stocks and the dollar in this deepening slump. This after President Trump's rejection of Jay Powell's interest rate policy sowed fresh angst among investors who are already trying to deal with a global trade war. I just want to bring in Gina Martin-Adams. She's Chief Equity Strategist for Bloomberg Intelligence. She joins us here in the Bloomberg Interactive Brokers studio. I got to tell you, Carol, on our call this morning, she's no longer impressed with a 1% decline or a 2% decline. She said, when things get above 3%, Tim,
come talk to me.
Come talk to me. And indeed, that's where we are now, Gina.
Okay.
That's where
Thank
we are.
you, Carol.
You're
Thank
welcome.
You.
You're welcome.
Yeah, it is pretty wild. I mean, I think that investors are really dealing with just a confluence of a number of risks. It's not only the chatter about Powell, which of course that is somewhat destabilizing to markets. It's also the dollar, which has really been falling out of bed at a time when stocks are falling and the dollar is falling. That's historically anomalous. Normally you see the dollar rising when stocks are falling as a risk-off sort of beneficiary. So that's not happening, and that's creating some risk. And then you've got earnings season, which frankly has been quite disappointing relative to expectations, especially given the pace of downward estimate revision, which is just weighing on sentiment, weighing on confidence, and it doesn't look like that's going to change anytime soon.
How negative was that pace of downward revisions? Can you walk us through that?
Really interesting. So first of all, the biggest thing that struck me so far this earnings season is the degree of sales misses. So 65% of companies that have reported have missed on the top line. That was for the first quarter.
Wow.
And that says something in an environment sort of when tariffs we were really just playing around with 10 to 25% spotty tariffs on Canada and Mexico and China. This was pre-Liberation Day. We were seeing sales misses start to emerge. So that's somewhat troubling. The longer term outlook, analysts have now taken down expectations for every quarter for 2025. They're starting to take down growth expectations for 2026 as well. The 2025 number is now at 8%. Pre-earnings season, it was at about 11. So we've seen a really big, that's growth rate. We've seen a pretty big reduction to expectations across every sector except for utilities. So it's fairly broad-based. And we're just at the start of earnings season. We will see a lot more of this likely emerge as the bigger companies start to report. And of course, we're just getting to some of the biggest tech companies, some of the Mag 7 companies reporting over the next couple of weeks.
Yeah, we'll hear from Tesla tomorrow. It is one of the big decliners in today's session, which we'll get to a little later in the program. I promised that you would have places to go that you recommend. And I'm not talking about we just got back from spring break. Charlie was in Mexico. You were in New Jersey. I was in Brooklyn. Yeah. We didn't go anywhere. Charlie got to go somewhere. If we do see a recession in the U.S., where should the money go?
Well, recession in the U.S. is not priced in any market that we follow around the world. I just have to caveat with that. There's downside risk still to every global equity market, according to our fair value models, if we actually fall into U.S. recession. What I think has been largely priced in the global equity markets is at least some weakness with respect to tariffs, but not enough weakness with respect to tariffs. One area that's really interesting is emerging markets. This is an area that we wrote about a lot over the weekend. And what we find is beta of several key emerging markets like China, like even India, is much, much lower than beta in the US. So the US equity market has a above 1 beta. That means in a downdraft, the US equity market falls more than global equities. China and India would presumably fall less just because of sheer beta. Saudi Arabia is a low beta market as well. UAE is relatively low beta. So I think you look at beta as a driver because in downside markets, the lower beta markets tend to survive best. We did see that play out a little bit in April. That could continue to be a story. The other thing that I think is quite surprising is even when we run our models and we say, what is the fair value of various markets? And how would various markets reprice to a U.S. recession? We actually find that Chinese equities are furthest along pricing a U.S. recession emerging. Despite the fact that we have such extraordinary tariffs, part of that is because the constituents of the Chinese exchange are not necessarily one-to-one representative of the Chinese market. So what's in the Chinese equity market is not necessarily what is in the Chinese economy. Right? The Chinese economy may be damaged by U.S. tariffs, but the Chinese equity market could be somewhat isolated from the tariff exposure. It's not a lot of manufacturers, for instance, of product that they're sending to the United States that exist in the Chinese equity market. So we see 10% downside risk to China, whereas our models say there's still another 20% downside risk to the U.S. market if a recession emerges potentially. The other area I would say risky, but nonetheless at least appears to be already priced for recession is the U.S. small caps. U.S. small caps, as of early April, were trading at levels that would, to the degree that normally would indicate we are in a recession already. So there is this interesting divergence that's occurred between small caps and large caps. Now, small caps are high beta. They're obviously very levered to the U.S. economy. It's extremely risky. But nonetheless, they do appear to have already repriced in line with what we would expect in a normal recession. Will the recession be different this time?
They're down 25%
it's always a little different.
from late November.
Yeah. I mean, they've just gotten absolutely crushed. And valuations are several multiples, so several standard deviations below S&P 500 valuations. So you've got some interesting repricing that has occurred across the global markets.
I ask you every time you come in about the make a cap names, and not even mega cap, but large. You say mega cap, but it's like that's because the S&P 500 is dominated by a few mega cap companies. But if we're thinking of the S&P 500 and valuations in there, where do valuations need to fall for you to say, okay, now we're actually seeing this in line with historical valuations?
Yeah, so...
and could that happen during earnings season?
Yeah, it could very well happen during earnings season. We've got a long ways to go. I mean, the S&P 500 is trading at roughly 19 times earnings. Historically, we cannot find a bottom in a crisis until we're at 15. So just the historical precedent would say you probably need to fall closer to 15 times earnings before you're saying, hey, deep value is emerging. That's, of course, for the index at large, which, as you correctly point out, has its idiosyncrasies, has its issues in terms of market cap concentrations. You know, there are most definitely opportunities that are emerging inside the index if you do your homework and you dig a little bit deeper to the industry and company level. It's just the index itself is still enormously overvalued considering the risks that we face right now.
I mean, is there an expectation? I think I heard something earlier on radio this morning about some folks saying, you know, we were out kind of early this year because we saw some troubles brewing, and then we've been slowly going back into some of those like big cap tech names that have just been so beaten up. I mean, are you expecting that investors at some point to say, I still believe Meta's going to be around, or I'm just throwing a name out, or Nvidia is going to be around, and that they start to buy in just because they've gotten so beaten down?
Yeah, they probably will. I think that you generally see that happen with a cycle. The trouble that we have this year specifically is normally those points emerge. Let's say we do fall into some form of U.S. recession. Normally the points of bottom emerge when you have a policy movement. Fiscal and monetary policy movements were required to create the bottoms in stocks in both 2020's recession as well as 2008, 2009's recession, right? So what happened in those instances? The Fed and the fiscal body together made a coordinated effort to reinflate expectations. We are not going to get that in 2025. You might get the Fed.
That's what I was going to ask.
You very well might get the Fed. They might be a little slower than President Trump would like to see. But nonetheless, if we do see decelerating growth, if we see the unemployment rate rising, if we see inflation relatively contained, the Fed will respond. It's their job to do so.
Why don't you think Congress will?
But I don't think Congress will do anything because of the fiscal deficit that we're still contending with as a result of the incredible inflation, the incredible package that the fiscal body put together for 2020 to save us from the pandemic. I mean, it just package after package after package in 2020 and 2021 resulted in the fiscal deficit that we have today. And there's not a lot of political momentum to spend more. It's going to be very difficult to fund those deficits. So you might get the Fed, which is sort of, to use a term that my kids would use, halfsies. We're halfway there, right? You might get some support to emerge to create a bottom, but it's very, very murky.
I talked about hiding under a rock. Like, it feels good now. Gina Martin Adams, thank you as always.
It's 3:21 on Wall Street. We do check markets all day long here at Bloomberg. We have got 39 minutes to go ahead of the closing bell. We got a manic Monday sell-off today with the Dow, the S&P, NASDAQ all retreating, down by 3% or more for the Dow, the S&P, and NASDAQ. Bottom line, heavy selling, stocks, the dollar, longer-dated securities falling after President Trump rejected Fed Chair Jay Powell's interest rate policy. The S&P now down 158, down 3%. The Dow down 1,157, also down 3%. The NASDAQ Composite Index down 524, a drop of 3.2%. 10-year at 4.40% with a 2-year yielding 3.74%. Gold is up $100 the ounce to $34.27, up 3%. West Texas Intermediate crude oil down 1.9%, $63.45 a barrel, and Bitcoin up 2.5%, 87,248. As for tariffs and market sentiment, Cameron Dawson is Chief Investment Officer at New Edge Wealth, and on surveillance this morning, she put it like this.
If this were a movie, we would say how to lose exceptionalism in less than 10 trading days, meaning that you have called into question these economic world orders that have been so powerful for U.S. companies and being able to benefit from falling interest rates, from the ability to benefit from rising margins over time. And so the end result is that we're all asking huge, major tectonic shift questions.
Cameron Dawson of New Edge Wealth interviewed on surveillance. NVIDIA shares trading near the lowest valuation of the AI era, but a growing list of perils has investors cautious about jumping in to buy the dip on NVIDIA. NVIDIA shares down today by another 5.6%. For on-demand news 24 hours a day, subscribe to Bloomberg News Now wherever you get your podcasts. I'm Charlie Pelleton. That is a Bloomberg Business Flash.
Hey, thanks for that update, Charlie. Do appreciate it. Well, there is a lot happening this week, and we've got our eye on all of it. Just an example, spring meetings of the IMF and World Bank. We got Vice President J.D. Vance holding trade talks with India's Prime Minister. We've got the anecdotes from the Beige Book coming. The president meeting with CEOs of major retailers to talk tariffs. I didn't even mention anything about earnings, which we're going to get to later in our program. But that's kind of like the backdrop, Carol, for...
It's a busy week.
Yeah, what's happening?
Yeah.
Spring break's over.
Yeah, spring break.
Spring break 25.
Move on.
We're also seeing a sell-off in U.S. assets as the president stepped up criticism of Jay Powell on social media. We just got the details from Charlie, but the S&P 500 still down 3%, though off its worst levels of the day. We got a great roundtable to help us make sense of what's happening in the global economy right now. Stuart Paul is U.S. economist for Bloomberg Economics, and Enda Curran is global economy reporter for Bloomberg News. Stuart joins us here in the studio. And joining us from Washington, D.C. Stuart, we've got longer dated treasuries joining stocks, the dollar deepening its slump. What is concerning to you and what's not concerning to you when you look across what's happening in the markets and in the economy?
The thing that's most concerning to me is that the U.S. is basically retreating from the existing global commercial order. Just this series of arrangements that we have for trading across borders, for engaging with our allies and giving them favored treatment, giving them access to U.S. markets. We're retreating from that role.
And you're seeing that with the dollar slump?
And and where it's being reflected in markets is in the dollar slump. Because as the U.S. is retreating from the global commercial order, folks are starting to get a little bit worried about whether they should hold dollar-denominated assets, period. Usually, if there were a recession, there could be a haven bid for something like treasuries, and you wouldn't see the sell-off in treasuries at the same time that you're seeing the sell-off in equities, which is being most clearly expressed by dollar weakness. Again, that retreat from U.S. dollar-denominated assets. So it's that dynamic that has me most fearful right now. The thing that I actually find heartening is that, as an economist, I just have this deep and profound belief that people do not stay irrational. Irrationality cannot persist. And so when you suffer the consequences of poor policy decisions, eventually you reverse course. So just as I am frustrated and discouraged in one moment by exactly what we're seeing in markets, maybe it's that economics bone that just kicks in and keeps me from being totally perplexed in perpetuity.
So, Enda, do you share Stuart's, I guess, enthusiasm that we could get kind of
Stuart's not hiding under his desk right now. Let's just put it like that.
That we'll ultimately get a course correct, that things kind of find their way in the right way, or I'm curious if you agree, but is it also depending on when that course correct happens? Because a lot of damage can be done to the U.S. economy, the global economy, and the U.S.'s standing in the world the longer this goes on.
Yes, no, I think Stuart has set the table very well there. I mean, for example, this week, Carol, we will have all of these finance officials, economic policymakers from around the world visiting DC, and it's going to be useful for two reasons, to your point. The first is we'll get a temperature check in terms of how much economic damage is being done, you know, how real is the pain for their companies, for their exporters, for the trading partners of the US, and how are they viewing the US as the guardian of the global economy by extension of that. So we're going to get a good temperature check in terms of the perception and US reputation in all of this through the comments we'll get over the coming days. We'll also obviously get new growth forecasts from the IMF. That will put numbers in terms of what damage people see. But then the other part of this week we'll also see, you know, how much of this can be undone. You know, to your point, will there be scope for deals? We'll have lots of finance ministers here, and will they come out and say, yep, we spoke with the US officials, we see a way out of this, and XYZ might come out of it over the coming weeks. That's an optimistic take. Or might we get more fractious comments making the point that, look, there's no easy way out of all of this. Tariffs are easier to put on than take off, and the mood might be more sour at the end of the week than it is beginning. So I think in terms of how this all plays out in the world economy, this week is a pretty unique one given the amount of visitors coming to DC, and I think by the end of it, we'll have a sense both of US reputation and the role in stoking this, and if there's a way out, near term at least.
And what does, you know, you mentioned the potential for deals, and maybe we'll start hearing about deals. Look, it depends on a country specifically, but what could a deal look like with a trading partner, for example?
Yeah, well, look, as you say, a lot of specifics we don't yet know, but broadly speaking, President Trump talks a lot about not just tariffs, but non-tariff barriers. He talks about exchange rates, he talks about subsidies, he talks about IP theft. He had a figure, I think, of $1 trillion worth of loss to the US economy from copyright and IP theft this morning. So one would assume these are the topics on the table alongside the tariffs. And you'll have to see now the finance ministers coming here, and some of them will bring their trade officials who will presumably be putting something on the table, providing the US has specific asks. But remember, there's two ways of looking at this. If you want to call it the war next China, maybe not. There's scope for some deals there. I mean, the signals from Japan last week were more mixed than the signals President Trump sent. The EU has sent some fairly mixed signals. But let's just say there's some scope for a meeting of minds when it comes to the US and the rest of the world ex-China. But none of that solves what will come after it, which is the big piece in all of this, the 145% tariffs on China. I mean, that's a whole other story. No hint of negotiations kicking off there. And I can't imagine we'll have much progress on that here in DC this week either.
Sometimes it's good to be in a category all your own, and sometimes it's not, certainly when it comes to tariffs. Come on back in, Stuart, because what is it that the Bloomberg economics team, how are you looking at the U.S. economy? Recession, no recession this year? A lot of people are also talking about 2026 and some like downbeat expectations. I think we got a little bit of that from some of our earlier guests. So I'm just curious how you guys see it.
We don't yet have a recession in our immediate forecast window. We are expecting material slowdown in growth, full year growth.
Will it be so slow that it'll feel like a recession?
It's definitely possible. The contour of how it feels is going to change throughout the year. For example, this year, or in the first quarter, we're front-loading imports. So one of the major items that's going to be dragging on GDP growth is imports. It's not necessarily going to be consumer spending and fixed investment. As we start getting into the summer, I think it's going to hurt quite a bit more, where folks do start pulling back. As Gina was saying, a lot of companies are reporting disappointing top-line numbers already. That was in the first quarter. That's part of why we do think that fixed investment's going to slow in the middle of the year. Firms didn't realize that revenue in the first quarter, so investment plans are going to slow in the middle of the year. And when investment plans slow, so too does hiring. So as we get into year end, we're expecting to see 5% unemployment, but we don't think it's until we get to basically that point that the Fed would then step in with another rate cut. We think that the Fed is going to stay pretty laser focused throughout most of the year on the price stability objective within its dual mandate before offering any sort of relief in the fourth quarter.
And one more for you, Stuart, on unemployment, and I want to bring Enda back in here because he's got a great story out today about the immigration crackdown compounding into blow from tariffs. But how would you characterize a rise in unemployment right now at a time where we're actually seeing immigration slow down?
Well, you have a few different dynamics. The first is the availability of labor supply. So if you have less immigration, then you're going to have relatively less labor supply. And what really matters, though, is less immigration, less labor supply. Is the existing supply going to be absorbed by firms' demand? And it's that balance that we're looking for, right? And right now, we are seeing waning demand for labor. We're starting to see less wage pressures emanating from the labor market. Right now, the ratio of jobs that are available to the number of unemployed workers is below that which persisted pre-COVID when core inflation was running under 2%. So the feedback that we're getting from the labor market into price pressures just isn't there. The labor market is cool. The price pressures that we're seeing right now are from under-saving and from the supply side.
So, Ed, come on in on this, because we had a really interesting conversation earlier with Thomas Carroll. He's over at Ballast Rock. They focus on multifamily in the Sun Belt. And he mentioned that he's already seeing prices of stuff they import to build these multifamilies go up as a result of tariffs on Canada and on Mexico, so those raw materials. And then also he's speaking to subcontractors who are having trouble finding talent when it comes to those skilled trades to actually do the work and get it done. So he's sort of hearing and feeling this on both sides. How does that kind of compound with what you and the team wrote about today?
Yeah, I mean, there are definitely many aspects to this, as Stuart just mentioned. But just to put it on a headline basis, the surge of immigration over the past few years was considered to have been important to offset labor shortages, keep a lid on inflation, and help the economy avoid recession. Now, the concern at the moment is that even before we get to the mass deportation phase, that the big crackdown on immigration, business people and economists are not advocating for illegal immigration or chaos at the border per se, but the end result has been a big crackdown on immigration. The concern is that some of those sectors, like construction, for example, are going to struggle to find workers. Some of those most exposed for those kind of labor-intensive jobs, maybe in food processing sector, in the farming sector, for example. Those are areas that are going to find it hard to get workers now at a time when they need them. So that concern is there, coming on top of the tariffs. But of course, as Stuart was saying, the bigger picture is the employment market is slowing too, of course, and that will offset some of those pressures.
Just quickly to wrap up in 20 seconds here, and I mean, if the U.S. goes into a recession, should we assume that the global economy will also go into a recession? Just quickly.
Definition of a global recession is quite difficult. I defer to Stuart, but yeah, if U.S. is in a recession, that's not good for the world.
All right, the ball's in your court, Stuart. If we get a U.S. recession, should we assume a global recession's coming?
There's been so much stimulus that's been put forward in the rest of the world. I think it's possible that enough stimulus in China and Europe could stave off a more material recession. But you know how it is. As the U.S. goes, so does the rest of the world. So if we do enter a U.S. recession, it would be difficult for me to be along Europe, for example.
It makes me wonder if we could once again have an earnings recession, but not necessarily an economic recession, because Gina talked about the numbers being brought down, certainly for the rest of this year, but also starting to look at, I guess, the early part of 2026. Folks, thank you so much. Stuart Paul, U.S. economist for Bloomberg Economics, and Enda Curran is global economy reporter for Bloomberg News. Stuart here in our New York studio, Enda out there in D.C. Guys, thank you so much. You're listening and watching Bloomberg Business Week. We're coming off our lows. This is Bloomberg.
It's 3:40 on Wall Street. We do check markets all day long here at Bloomberg. Heavy selling on Wall Street. We've got 20 minutes to go ahead of the closing bell. Stocks and bonds are sinking in a broad retreat. Let's head right over to the first word breaking news desk for today's afternoon call. Here he is, Bill Maloney.
And good afternoon, Shai. That's right. U.S. stocks are sinking again today with Trump upping the pressure on Fed Chair Powell. The Dow's currently down 1,100 points. S&P's dropped 2.8%, and NASDAQ is lower by 3%. The U.S. 10-year yield is at 4.4%. Gold is at an all-time high. Oil is sinking, but Bitcoin, that's higher by 2.5%. Among the main 11 S&P sectors, all were trading in the red, led by declines in consumer discretionary and tech. And all the Dow stocks were trading in the red, led by declines in NVIDIA and UNH. In other news, Trump, when asked about the EU, said we'll end up having a deal. And wrapping things up, Netflix was one of the few tech gainers today, rising 1.5%. Live from the first breaking news desk, I'm Bill Maloney. Charlie?
Okay, we thank you very much, Bill Maloney. Stay with Bloomberg right through the close to see how things shake out and to hear live breaking news over your Bloomberg type squawk, SQUA, on your Bloomberg terminal. I'm Charlie Pelleton. That is a Bloomberg Business Flash.
Hey, thanks so much for that update. Really do appreciate it. Well, we heard the numbers from Charlie Pellet just now. Seeing a little bit of buying into the close. Carol Master, the S&P 500 down 2.8%.
You know, when I see that, I'm always like, I love watching kind of the last hour of trading because we'll see if this holds, but definitely off our worst levels of the session. But you were just looking at the S&P too. I mean, we've seen broad-based selling throughout the day, but right now you've got, I mean, it's only 22 names that are actually higher in the S&P 500,
Good
481
luck,
to the
Carol.
downside.
Good luck to you on those.
Fingers crossed, fingers crossed.
Hey, I want to see what Jeff McClain has to say about this. CEO of Solidarity Wealth. He joins us here in our Bloomberg Interactive Brokers studio. In the wealth management business, they've got just under $700 million in assets under management. Jeff, good to see you. Welcome back. When you walked in, you actually mentioned that you were seeing some buying into the close. Yeah. Taken together, everything we've seen over the last few weeks, what does the environment look like to you right now?
I mean, obviously, the sentiment is so negative. I think that's part of the frustrating thing because the data is not there to support it. You're seeing consumer sentiment surveys down at like 2008, 2009 levels.
Yeah.
Do I think it's 2008, 2009? I do not. And so that's part of the surprise a bit of how
Because you think it's worse?
No. I definitely, oh man, can you imagine?
Why are you so optimistic? I mean, we can go over the list of concerns that people have. Today, top of mind for folks is fear about the independence of the central bank here in the U.S. and what the president has said about the chair of the Federal Reserve. There's the tariff concerns as the president meets with some of the heads of the big retailers at the White House today, and the concerns about, as we heard from Jay Powell last week, prices rising as a result of these tariffs.
Yeah, because
and growth slowing.
There's a common denominator to everything you just said.
Tariffs?
Which is President Trump, right? The Trump administration. And so a lot of this, it's not based on some market fundamental. It's not based on something broken like in 2008, 2009, the housing sector and credit default swaps and all the issues that came up through that. It's all based on what's coming out of the White House. And so that's why I'm both nervous, but also excited long term because there's nothing fundamentally broken right now. It can be cleaned up. Now, how he's going about it's not ideal, and it's freaking out people. It's creating uncertainty, which is the buzzword like we're talking about as a firm. Uncertainty is killing the market right now. And you can point to any of those policies you just said. That's what's driving it, is people don't know what's happening next.
I just want to remind you, we're 3 months into this administration.
Yeah.
And these are 4-year terms.
Yeah. But I do think there is a long-term plan associated with tariffs of, again, it's a shock and awe he's going into. I think long-term, everyone but China, I think those tariff issues get worked out here over the next 12 months. China, I think, consistently will go for the life of his presidency, that trade war, trade battle issue.
Ooh. Yeah. Like 145% tariff for the whole presidency?
No, I think they'll be fighting over trade policy the entire time. President Xi, President Trump are going to be battling because he has this fundamental view, President Trump does, of how unfair they are. Now, whether you agree with Trump or not, the data is pretty clear that China has been very lopsided in their trade policy of anti-U.S., stealing intellectual property, and doing a variety of different things to hurt us. But I think over time, again, a lot of this can be corrected by President Trump. That's why I'm a little bit bullish, because it's, again, nothing's broken right now, but it can lead to disaster. That's where he's on a dangerous game right now. Consumer sentiment is so negative that unless it turns, this will lead to a recession without question. It has to turn, or we're in a recession.
Having said that, if we are seeing, though, ultimately, even if trade deals are worked out and there are tariffs on goods that come into the United States, higher prices for Americans, right? And that changes the dynamic of potentially with the U.S. economy, right? People have just so much money to play around with. So something will be cut back on potentially. And that changes kind of the composition and velocity within the U.S. economy. So even though a deal might be worked out and we cross that off the list, you come back to different fundamentals.
Yeah, and it really depends on the type of deals, right? Even the 10% tariffs on all the other countries are a problem, right? And so if he can...
10% maybe sounds like not a lot, but what we're at, 2%, 3%? I mean, that's a big jump.
But if he can wipe out, as part of this, again, it's not to go too much into the political side, but if he can wipe out the tariffs that they have on us and all the other non-tariff trade policies going country by country, that can be a huge boom long-term. His issue is his short-term could drive us into a recession, and there's no way a Republican's being reelected in 3.5 years if he drives us into a deep recession. That is gone. So I think he's playing a dangerous game.
But is that the concern or the recession that's on the U.S. that was not one we had to have?
His concern or my concern?
No, I'm just saying, I
think,
think about the longer term damage, right?
Yeah.
Of, do we have another generation that comes out of college and can't get jobs? And that means you can't buy houses and you can't, you've got student debt. I do wonder, when do we move towards thinking, all right, folks, there's going to be some longer term impacts on certainly Americans and the American economy.
Yeah, I think the American economy, and specifically around job market, I think those always turn in a positive manner over time. The issue long-term to me is the international view of U.S. investment. That is concerning, of where my worry lies of long-term, especially around the treasury market. So if you're a person coming out right now, or just an average worker trying to get a new home and get a mortgage right now, good luck, right? Your 30-year average is starting with a 7 handle roughly, right? That's really high than what we're used to. A lot less than what our parents paid, right? Double-digit mortgage rates, right? But still, that is a difference maker. And so I think that's why he's trying to beat down the Fed chairman a little bit in inappropriate ways to get those mortgage rates down, because he knows if he has a slowdown in the stock market and the cost of buying a house is high, jobs start being few and far between, he's creating a tempest to fight through.
Speaking of beating down.
Yeah.
Segue to Novo Nordisk.
Yeah.
A stock that has been beaten down, but you're optimistic on and you've taken a position in.
Yeah, we took a position last week. We like Novo for this. It's back down to almost its pre-GLP-1 level.
That's wild.
Right?
That's a huge decline. I mean, we were reading stories in the last couple of years this is Denmark's economy.
Yeah.
Truly.
Yeah. Yeah, and the thing is, the fundamental business that they already had, diabetes, insulin, not going anywhere, right? As the world gets wealthier, diabetes, insulin, obesity, all those things go up. And so you're basically getting the GLP-1 business for free right now, because it's back down to roughly pre-GLP-1 taking off levels. And so for us, down nearly 60% year over year, still a great management team. I think there's plenty of space to be had in the GLP-1 market. Everyone's looking at Lilly right now as the clear leader. I think there's plenty to be had there. We're still in the early innings of GLP-1, remaking the health area and having people...
But is it contingent that they are able to create a pill just like Lilly?
I think there's going to be a lot of innovation there. I'm not worried about the method of intake, whether it's a pill, a shot, whether it's something that dissolves in your mouth, right? Whatever, a patch. I think the method of intake is less concerning to me. It's more just the business itself. And Wegovy has staying power, right? And so I'm getting it for free, essentially. I'm buying the diabetes insulin business, and we're getting GLP-1 for free. I mean, that to me is marketable. The management team is good. I trust the Danes, right? We'll see what they can follow through on, but they look good.
We got to run. Thank you so much.
Yeah.
Good to spend some time. Jeff McLean, CEO of Solidarity Wealth, joining us here in studio. Folks, we're counting you down to the close. 10 minutes to go, and we're rounding around the worst levels of this session. This is Bloomberg.
This is Bloomberg Business Week Daily with Carol Masser and Tim Stenovec on Bloomberg Radio and Television.
All right, everybody, we've got just about 7 minutes to go until we bring you the closing bell on Wall Street. We're going to head over to our TV colleagues. Do want to mention a headline crossing. The wife of former Senator Bob Menendez, convicted of accepting bribes of gold bars, cash, and a Mercedes-Benz in exchange for helping her husband corruptly use his power to assist businessmen and the Egyptian government. We're talking about Nadine Menendez, 58, of course, her age, found guilty today in the same New York courtroom where her husband, of course, a Democrat from the state of New Jersey, was convicted last year with 2 businessmen and sentenced to 11 years in prison. Prosecutors saying Nadine Menendez and her husband, the former chairman of the Senate Foreign Relations Committee, were, quote, partners in crime. So this just crossing the Bloomberg terminal.
A couple other stories we got our eyes on the most read list on the Bloomberg terminal. We've been speaking about this millionaire tax, Carol.
Yeah.
And the idea that the Republicans would actually propose to impose a tax hike on millionaires, and how much money there is actually behind that.
Yeah.
It's pretty remarkable.
We're talking about what? Republican proposal, as you said, on millionaires offers to generate about $400 billion over a decade. So we're talking, what, $40 billion a year. That's according to 2 new estimates provided to Bloomberg News. So providing some fresh revenue to partially offset the cost of the party's multi-trillion-dollar tax package. So this is where the math is going to matter.
Yeah, and that's why. So I'll just go through the numbers that we got at Bloomberg News. The Budget Lab at Yale projects that taxing income over $1 million at a 40% rate. So remember, this is income above $1 million. So income up to that would be taxed at a lower rate, would generate about $420 billion over a decade. Then you have the Tax Foundation in its own preliminary analysis finds that the new bracket would raise $358 billion over that same 10-year period. That's according to the Director of Policy Analysis for the think tank. These are 2 nonpartisan think tanks. They differ slightly because each group uses different assumptions about economic performance. The figures, though, suggest that the creation of a millionaire tax bracket could help President Trump enact some of his campaign trail pledges, including eliminating taxes on tips, which is estimated to cost about $118 billion over 10 years.
This is where you need the spreadsheet, folks. You need to know coming in, what's going out, what are the costs of things to kind of figure out what we just talked about with, some of our guests. And I forget, was it Gina who pointed this out, this idea of this, kind of fiscal situation where if we get into a recession, then there is the ability, if inflation is in check, where the Fed chair can cut rates. But it's very hard for Congress to maybe help with spending packages to help out because the deficit continues to grow. And this is where, in terms of what the president's trying to do, to watch in terms of what's spending and what's coming in.
Maybe we know how the president feels about a millionaire's tax. Some other Republicans in Congress not so excited about it. The concept of higher levies on top earners runs really counter to years of Republican orthodoxy. Steve Scalise, who's House Majority Leader, he's pushed back, saying that oppose any rate increase. Iowa Senator Chuck Grassley told constituents at a town hall last week that an increase in the top rate is slated to be discussed in the Senate Finance Committee, but added that doesn't mean it's going to happen.
Yeah. Nicole Maliotakis of New York, the state of New York, House Ways and Means Committee member, she says it's certainly on the table. She said that today on Bloomberg Television. So, yeah, this is kind of the next step, right, in President Trump's plans. Tariffs were certainly the first step he took, and now it's getting into a budget, spending, tax cuts, which some say could be then stimulative in terms of markets and the U.S. economy, but time will tell, and we'll have to see how these details work out.
Hey, I'm looking at stocks, Carol, and they're off their worst levels of the day. The S&P 500 is down only 2.4%. I say only because it was down more than 3% earlier in the session. Still, the vast majority of stocks are lower. You have 36 stocks moving higher, 467 in the S&P 500.
Yep, and we're watching also
moving lower. Did I say 37 higher, 466 lower? Excuse me.
There you go. That's all right. There's a lot going on. Got a 10-year note
right
now with the yield of 441, 2-year note with the yield of 375. We've seen the yield curve certainly move up. Those yields moving up in general overall. So, all right, we're going to count you down to the close on this Monday afternoon and see where we ultimately end up. Talk about some of the stocks that were winners and losers. It's all coming your way in just a moment. We're heading over to our TV colleagues. The closing bell starts right now.
The Closing Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close, starts right now.
About 2 minutes away from the end of the trading day, I'm Alex Steele, and alongside Scarlett Fu, we're going to take you through the closing bell in a global simulcast. We're joined now by Carol Masser and Tim Stenovic, bringing together our Bloomberg television, radio, and YouTube audiences worldwide to parse through the most crucial moments of the trading day. Guys, I haven't been on air for about 5 whole days,
Okay.
5 whole trading days,
Welcome
and it
back.
feels like it's the same deal. We're just selling here, selling, right?
You're welcome. You're welcome.
We had some up days last week, though, at the beginning of the week.
Long
Alex, that
forgotten
we
right
missed.
now. Yeah, but it's like, no, we're just going to still stay into the selling mode. Yeah?
I will say, interesting to see some buying into the close. We talked earlier with our Eric Weiner, though. He said that volume was kind of low here, but nonetheless, to see in the last few minutes of trading that there are some investors finding some opportunities, even though broad-based selling and a lot of names are down. I think that's a little bit of a positive sign, but little one.
Okay, all-time high for gold. We knew that. Have you guys seen what Bitcoin is doing? This is a little wild. Bitcoin's at its highest going back to the end of March. It's up another $2,200 today. The moves counter to what's happening in other risk assets today.
Yeah, well, short-term treasuries are also up, and short highly rated credit is also up. So those are your havens today.
You know, it's down the dollar. We're at a 3-year low when it comes to the dollar. It still feels like it's sell equities, sell the dollar, sell the long end of the curve. So it's still that sort of push to selling U.S. assets, and I just wonder kind of how much that theme has to go.
Yeah, exactly, right? That's what we're trying to figure out. Where do we bottom out? And you keep thinking maybe earnings are going to help us, but we talked with our Gina Martin-Adams, and it feels like people continue to, reduce those earnings estimates for this year as well as into next year.
Ooh, great timing, guys. There is the closing bell on this Monday. You're looking at S&P closing off about 124 points. That's about 2.3% off the low, so a little bit of buying into the closing bell. The Dow Jones Industrial Average, guys, off by about 2.5%, and the NASDAQ off by 2.5% as well. That was the big underperformer, guys, but it feels like now we're pretty much on par. And I'm just taking a look at the Russell, the small caps closing right in line, 2.1%, Carol.
All right, and as we've been saying, broad-based selling, though, on this Monday. So if I look at the S&P 500, roughly 463 names to the downside, and you've got about 39 holding on to some gains here.
All right, let's take a look at the IMAP. Pretty simple today. There's no cheese, there's no pesto. It's just all red sauce and maybe some pepperonis in there. Everything is down across the board. 11 sectors all in the red. Even when you slice it into 24 industry groups, Carol, all 24 groups are falling as well. The better performing groups, food, beverage, and tobacco, consumer durables, and apparel. So that gives you a sense of where some of the safer places to hide might be.
It's like a super bad sunburn. That's what it looks like. All right, let's get to some of the individual gainers. Cross my fingers that they're holding on to it. Netflix up as much as 4.7% today, closing with about a 1.5% gain. This is a top gainer in the NASDAQ 100. Saw it higher too in the S&P earlier. Some momentum. I forgot, like earnings on Thursday before the long weekend. It feels like a lifetime ago. We did get that. The company did come out and it did forecast revenue for the second quarter that beat the average analyst estimate. And analysts are seeing the company's business as resilient amid a tougher macro environment. So the expectation is that, maybe Netflix is one of those things that you don't.
Well, here's my question, Carol.
Yeah.
Is Netflix discretionary anymore?
Well, exactly. I mean, there's been a lot of research, right, where folks are saying, or, that maybe it is, you got to have this. Like, it's a cheap
it's a utility.
luxury, right?
If you cut the cord, then you probably have Netflix.
That's what I'm saying. Like, there's no way that I would let that go. I would let go other apps before Netflix. Anyway, I digress.
All right, consumer staple then. All right, Discover Financial, number one gainer in the S&P 500, up about 3.5%. It was up more than 7% during its highs today, but still holding on to about a 3.6% gain. Capital One receiving approval on Friday from U.S. regulators to buy Discover, and this creates the nation's biggest credit card issuer by loan volume. Capital One, we also saw trade higher in today's session. Analysts kind of weighing in. They say maybe we could see some more consolidation, and they do say the deal creates significant value for shareholders. So that's a pop here in today's session. And Fidelity National Information Services, FIS is the ticker. This went up about 2.4%. This is your number 3 gainer in the S&P S&P 500. Payment services company raised to buy at both Citi and TD Cowen following recent deals with Global Payments, sale of a stake in WorldPay, and purchase of an issuer solutions business, making the company's business model steadier. That's according to TD Cowen. So some decent gainers in today's session.
Some decent decliners in
lots of
today's session is another way to put
Embarrassment
it.
of riches for you.
It really is. I mean, look at Tesla right here, down 5.8%. It was down as much as 7.7% earlier in the session. Questions remain over Elon Musk's role within the federal government and uncertainty over the company's plans to introduce a lower-cost EV. Dan Ives over at Wedbush out with a note over the weekend that said Musk should step back from his government work and focus on Tesla, citing brand damage and a potential 15 to 20% permanent demand destruction. Here's what he wrote. Musk needs to leave the government, take a major step back on Doge, and get back to being CEO of Tesla full-time. Tesla is Musk, and Musk is Tesla, and anyone that thinks the brand damage Musk has inflicted is not a real thing. Spend some time speaking to car buyers in the U.S., Europe, and Asia. Once again, Dan Ives over at Wedbush out with that note. Shares are down more than 50%, though, from those highs back in December. Moving on to another mega cap name, Amazon. Falling in today's session, down a little over 3%. It was downgraded by Raymond James due to anticipated earnings pressure from increasing investments in U.S. tariff increases on imports from China. Despite the downgrade, 95% of analysts that are tracked by Bloomberg do recommend buying the stock. Some cite attractive valuations relative to its history. And finally, how about one for the folks who go out to lunch? Sweetgreen, down today by 8.2%. It was down as much as close to 12%. This after the company said its COO would leave the company, and separately, B of A cut the target from $36 to $31. Sweetgreen shares are down more than 61% from their highs back in November. So
yeah, that's because $20 salads may not be most people's staples. That's like definitely a cost you
it's
can
like
cut.
a Netflix, a full subscription to Netflix for the month in a salad, right?
Yeah, like what would you do? A salad per day or Netflix? You keep Netflix, you boot the salad, and you eat food at work. Not that I do that. All right, guys, I'm going to the bond market. You're seeing buying in the front end, selling in the back end. This is a very typical situation over the last couple of weeks. That curve steepening. If you look at the 2 in the 30s, this is the steepest curve since January of 2022. And the velocity and the move that we've seen this has been quite staggering. And I just wonder how much more juice there is to go. I mean, that 5 year, I mean, the 30 years almost at 5% at this point, guys.
Yeah, it's pretty remarkable to continue to see the steepening of the yield curve here. And, you know, it makes the Fed's job much more complicated as well going forward. Not to think that Jay Powell had it easy at all, given the kinds of things that President Trump is saying about him on social media.
Yeah, listen, I mean, it just is another uncertain, aspect to the overall environment that is full of so much uncertainty right there. And so you just think about what's ultimately the impact, right? We've talked so much about CEOs maybe not spending, CapEx spending, and maybe not hiring, and all these things just ultimately put a damper on the economy. You just kind of think about where this ultimately will go, or could it change in 24, 48 hours, or in 60 days or 90 days. I guess, that's kind of
the next 3 years.
Look, who knows if it's going to change over the next 3 years or 24, 48 hours. What I do know is over the next few days, we are going to hear from a lot of companies, including Tesla tomorrow. That's certainly a big one. We'll hear from Lockheed Martin this week. We'll hear from Boeing on Wednesday. We got Texas Instruments. We got IBM. We got Norfolk Southern. We got Intel on Thursday. We also got Alphabet coming up as well this week. So a lot of questions that I know analysts are going to have about CapEx, hiring, how these companies are looking at tariffs, and hopefully we'll get some answers this week.
I was telling Scarlett that I spoke to Gina Martin-Adams of Bloomberg Intelligence on Bloomberg Radio earlier today, and she said that 65% of companies have missed sales in the first quarter so far. So what does that mean? Is that because the sectors that we got just happened to miss sales? Is that because expectations were just too high anyway, and everyone thought that it was going to be pretty easy to beat any sort of tariff issues, and then we realized that wasn't actually true? Or are we really going to see some earnings season roll over here? And if that's the case, do we need to lower our estimates for earnings for the whole year from 8% to what? ... Question mark.
That's so interesting, given that we know anecdotally so many companies are front-running the tariffs by buying a lot of what they need. I think about, a lot of consumers going out to buy a lot of stuff right now before the tariffs come into effect. If you're still seeing revenue decline, what does that say for when the tariffs are actually in place and people are really holding back on their spending?
I want to go back to what you were saying, Alex, because we talked with Gina too, and that revenues miss was really surprising. And then she also talked about, analysts basically, talking down their numbers, the projections for this year and what they expect from companies. But then she said they're starting to do it into 2026. So, that's a pretty negative sentiment and has to be a little bit worrisome at this point.
At the same time, perhaps we'll start to hear about one-on-one trade deals being reached with different countries. I think certainly the one that has most investors concerned does include China, but maybe we'll start to hear from the president and the folks working on trade policy when it comes to individual countries, and that maybe they've reached deals. So some clarity there, perhaps.
How are we feeling, guys?
It's a Monday.
It's a Monday.
Monday after a shortened week.
Whew, it's a rough one. All right, that's our cross-platform coverage. Radio, TV, YouTube, Bloomberg Original, Scarlett and Alex continuing over there on television. Tim and I are going to continue here on Business Week. We'll see you again, same time, same place tomorrow.
This is Bloomberg Business Week Daily, reporting from the magazine that helps global leaders stay ahead, with insight on the people, companies, and trends shaping today's complex economy, plus global business, finance, and tech news as it happens. Bloomberg Business Week Daily with Carol Masser and Tim Stenivek, live on Bloomberg Radio, television, YouTube, and Bloomberg Originals.
All right, everybody, we are continuing here on Bloomberg Radio, on YouTube, and on Bloomberg Originals. Carol Masser, Tim Stenivek. And yeah, so we wrapped up our first trading day of the week. We talked about lower volume, and we did see some buying into the close, but still a bunch of broad-based selling. And I'm just looking at the VIX, Tim, popping up about 4 points here, 33, so just under 34 here. We know it's been a lot higher over the last couple of weeks in terms of the tariff volatility and the impact on financial markets, but everybody has said it was going to be a volatile year, right? And here we are.
They were right.
They were right.
We got a great hour
Well
coming
done,
up.
you.
Final hour of Bloomberg Business Week. We're going to be speaking with Kathy Entwistle over at Morgan Stanley Private Wealth Management in just a minute. We also are going to be speaking with Max Chafkin a little later in the program. He has got a great story on the architect shaping Trump's agenda. Not a household name to a lot of folks.
I got to say, we have two great stories from our Bloomberg News team and Business Week team. And Sarah Fryer gets into a story, too, that how some people have talked about the 2024 presidential election being the podcast election. She talks about the strategy for President Trump, where it all came, and really one key individual. So great stuff coming up this hour. In the meantime, we do want to talk with Kathy. Kathy is Managing Director at Morgan Stanley Private Wealth Management, Kathy Entwistle, and she joins us from Ridgewood, New Jersey. Kathy, the more this goes on in terms of the volatility, the tariff talk, the figuring it out, the uncertainty talk, or mood, I should say, how does it make it more difficult for your investors?
Thanks for having me, Carol and Tim. And to answer your question, I think it's a very difficult market. It's a difficult environment. And trying to find some of those common themes that we can find in years past to walk our clients through this time period is definitely challenging. There's a lot going on. But I do think there is a path forward.
What's the path forward?
Well, the path forward is to take a breath, to look at your long-term horizon. It's kind of boring, but we do a lot of financial planning for clients and we match their goals up with their investments. So if you were a long-term investor to begin with, this volatility is normal and we've run numbers through the plan to make sure that clients are still on track. So that at least gives them that sleep at night or at least sleep partly through the night in this time period. While we're getting through the more difficult time period and also making, small adjustments to the portfolios in order to capture where we think we might be going, i.e. where's the puck going, and also what little changes we can make to improve on that portfolio.
I do think that, certainly the U.S. has faced downturns, and even investors who have a short memory certainly remember what happened in 2020 in response to COVID and then the quick uptick in equity prices just after a few months there. Older investors remember other downturns, .com, 1987, of course, the great financial crisis, 08, 09. We talk about those all the time. I think one concern that folks have right now is there's a difference here in the fact that a lot of the concern stems from, we heard it a little earlier from our guest who we spoke to driving to the close, stems from an individual at the White House and the decisions that he's made, and also a concern that maybe the economic order that a lot of us grew up with is undergoing some sort of massive shift. And I'm not going to say those dreaded words, this time is different, but I think a lot of people do think that this time could be different.
Yeah, I am hearing from a lot of clients, well, this is different. There's something else driving it. Maybe there's not going to be the same stimulus coming through from the government that gave us some of those pops that we've had in the past. So when we're talking to clients, we did go into 2025 with the idea that we are going to be in a trading range and it is going to be very bumpy and volatile. I don't think anyone expected it as quick or as extreme in the short term as it has happened. And basically, if you blink, something has changed. And you need to really pay attention in these markets to follow what's going on and also potentially to take advantage of some of the disruption in the market. So you mentioned earlier, and we agree completely, we are advising clients to keep some money in short liquid assets.
How much, Kathy? I'm just curious, like how much are you telling them to be? Yeah.
Usually they're like 10% of the portfolio or enough money that they feel comfortable over the next year or so, if we're bumpy, that they have a cushion on the side for themselves. So 10 to 15% seems like a good number.
You're not saying, hey, listen, folks, I think this U.S. market's going to be a rough one until President Trump is out of the White House. So maybe you want to think about Europe. Maybe you want to think about emerging markets, which is something we talked about earlier. Anybody that is wanting to do something different because they don't feel good about the U.S. market right now?
Yeah, we're definitely getting some people are interested in investing overseas or pulling their money out of the U.S. I am hearing that for sure. But for the most part, the majority of our clients are taking a stance where they're going to stay firm, be patient and calm. It's difficult to do, but it's one of the times where you really have to stay on your plan and on where you expect the opportunities to be. So whether that be very simply moving from growth, aggressive growth and growth opportunities to more value opportunities, some more solid, maybe more boring opportunities, but the areas that are paying you, the companies have good balance sheets. We've been saying for a while now that stocks like the Mag 7 are overpriced. There's going to be issues. It's really hard to let go of those companies when they're performing. There's a lot of FOMO going on. And now there's a lot of people who are probably kicking themselves saying, maybe I should have pared down a little bit on that.
Do you think that the president will succeed in reorganizing world trade and the U.S.'s place when it comes to trade?
I'm not going to opine on that per se, but
it would have serious market implications if he did, if he were successful.
Yeah, from the market implication standpoint, I would say, it's really difficult to watch what's going on in the markets right now, and it's difficult to see, on paper, losses across the board for individuals and as well as the risks to corporations, which then of course will affect those who are working. So there's a lot of issues going on right now. And one of the concerns is even, you were talking earlier, treasury yields. How expensive is it going to be for the government to issue treasury bonds when that comes up shortly? So there's a lot of issues that are going on that are going to affect the markets, the economy, and also, what they say, you don't call somebody for 3 months or you mistreat them badly for 3 months. Eventually, they are not going to call you back. So I think we have to be very careful about how we manage our communications with the outside world and also, tariffs and economics and things like that. It's going to be important.
So what you're saying is that this short term ultimately will determine the long-term standing of the U.S. in terms of investments and standing in the world.
I do think that what happens over the next 3 months or even shorter than that is going to make a difference and an impact on the world and how they see us and our position in terms of being able to produce products and import, export, and things like that. So it's a very, very important time period in history, and hopefully we will end up on the right side of the page.
All right, fingers crossed. Yeah, interesting times, no doubt about it. How many times do we say that? Uncertainty, interesting times.
Take a drink, Carol Massar, even though it's Monday.
It's never too early to start. Kathy, thank you so much. Kathy Entwistle, she's Managing Director at Morgan Stanley Private Wealth Management, joining us from Ridgewood, New Jersey.
No wine until after 5 on a Monday here in the studio.
We got a long week ahead.
We got Tesla reporting tomorrow after the bell.
Yeah.
Think Elon's going to be on that call?
They've had a rough couple of months. I don't know.
Down about 50% from those December highs.
A lot of questions about the future and the outlook, so looking forward to that one. Hey, folks, do not go anywhere. We continue right here on Bloomberg Business Week. 2 killer stories about how Trump basically got to the White House, I think is safe to say. This is Bloomberg.
It's 4:21 on Wall Street. We do check markets all day long here at Bloomberg. Triple-digit loss for the Dow Jones Industrial Average today, down 971 points, down 2.5%. Stocks lower across the board. President Trump's rejection of Jay Powell's interest rate policy deepening angst among investors already coping with a global trade war. Today, the S&P tumbled 124 points, ended off session lows, but still down 2.4%. The Nasdaq Composite Index index was down 415 points, down 2.5%. The 10-year 4.40%, with the 2-year 3.75%. Spot gold today was up 2.9%, higher by $95 the ounce to $34.22. And West Texas Intermediate crude down 2.1%, $63.34 a barrel. 10-year 4.40%, with the 2-year 3.76%. NVIDIA shares trading near their lowest valuation of the AI era, but a growing list of perils has investors cautious about taking advantage of the dip. Today, NVIDIA dropped another 4.5%. Recapping stocks lower, S&P down 124 points, down 2.4%. For on-demand news 24 hours a day, subscribe to Bloomberg News Now wherever you get your podcasts. I'm Charlie Pelleton. That is a Bloomberg Business Flash.
Hey, thanks so much for that update, Charlie. Do appreciate it. Well, it is today's big take. It's also one of the most read stories on the Bloomberg terminal. It's about the self-described boring budget guy who's best known for co-authoring the 900-page policy playbook of the Heritage Foundation's Project 2025. It's become something of a Bible for President Trump's second term, and it's he, not Elon Musk, who's steering the Trump administration's Doge crusade. Business Week columnist Max Chafkin writes about Russell Vogt for Bloomberg Business Week. He's also the co-host of the Elon Inc. podcast and the author of The Contrarian, Peter Thiel in Silicon Valley's Pursuit of Power. He joins us from our Dallas bureau. Max, who is Russell Vogt?
Yeah, Russell Vogt, well, he is the director of the Office of Management and Budget. But more than that, Tim, as you said, he is one of the core ideologues behind this presidency. So Russ Vogt, he served as the head of OMB at the end of the last Trump presidency, and his big idea really goes around executive power. And it's this idea that the executive, that's the president, Donald Trump, should be able to have much, much wider discretion to run the government and really to run the country than I think most, even either Democrats or Republicans, have generally allowed in the past. He's also a big-time deficit hawk. He started his career working for Phil Gramm. He was a senator starting in the 80s, was one of the key people behind the effort to balance the budget in the 80s and the 90s. And so Vogt has these two threads, one deficit hawkery and the other being executive power. And as you kind of hinted in that intro, those two things work really nicely with what Elon Musk is trying to do. Because, of course, Doge is about both of those things. It's about cutting the deficit, but also sort of doing things more aggressively, with the power of the presidency. And so Vogt and Elon Musk have this kind of interesting alliance. And it's especially interesting because they're so different. They couldn't be more different from one another.
All right. So having said that, we focus so much on Elon Musk. He's been the face out there in public in the Oval Office when Donald Trump is holding, the President Donald Trump, of course, is holding press conference about what Doge is doing and so on and so forth. So I guess there's an assumption that once maybe, there's been some speculation that maybe Elon Musk, his days at Doge are numbered, that's it. And yet that's not the case, is it? If that's how it plays out. People within the Trump administration definitely don't see it that way. I mean, as you say, Carol, at some point, Elon Musk is going to have to give up his full-time role in the Trump administration because he is a temporary government employee. That is going to sunset after 130 days. We don't know exactly what that'll be, how exactly they're counting the days, and it would not surprise me if it stretches on. But at some point, Musk is going to take a step back, and certainly within Trump world, this is seen as being part of Russ Vogt's domain, and that he and people around him are ready to pick up where Elon Musk left off. And it's not as if I don't think Elon Musk is going to go away from the world of Trump. I think he'll still be very vocal on social media, but when you're talking about that day-to-day role, it will go away. And if you're thinking that Musk going away is going to change the trajectory of what Trump is trying to do, I think you would be mistaken, because Russ Vogt has been working on these issues for years, long before Elon Musk
proposed the idea of Doge. Vogt was proposing sort of very similar things from his perch as the head of this, MAGA think tank, as being one of the kind of leading lights intellectually in Trump world.
All right, and as you talked about, I mean, he's very different than Elon Musk, and so I do wonder, what's the speculation about how these cuts and things might play out if Elon Musk leaves and Vogt he's in charge?
Yeah, the difference is it's almost comical. So Musk, of course, he loves to be front and center. Vogt, very low profile, barely talks about himself. Rarely gives interviews. Rarely gives up any personal information. We know everything there is to know about Elon Musk's personal life. Musk, of course, ideologically scattered. Vogt is very, very disciplined, and that. You could see that in two different ways. On one hand, I think there's some people who see Musk kind of working against Vogt and some of the ideological components of Trump's base. On the other hand, Vogt and people close to him see Musk as this kind of force multiplier, as this face of this otherwise maybe difficult to sell operation. You have this very popular, out there guy in Elon Musk representing these changes in the public. Meanwhile, behind the scenes, you have Russ Vogt and his allies doing the actual work.
Well, so what have they been able to accomplish thus far? Because Project 2025 was brought up during the campaign quite a bit, in fact, by Democrats. And the president at that time distanced himself from Project 2025. What have they been able to accomplish?
Yeah, there's a lot there. I mean, Project 2025 has a large number of co-authors in terms of, and they're different positions. Like if you look at the tariff section of Project 2025, there was a pro-tariff section and an anti-tariff section. There were actually like two dueling proposals. Vogt is pretty much aligned with Trump on everything. So he was for the tariff. He was publishing, these very hawkish pieces about tariffs in the years running up to the election. And in terms of sort of executive power, this idea that Trump should be able to run the government, I mean, that is a place where they're making a lot of changes. I mean, we're seeing, some of this is caught up in court right now, and it's unclear how many of these attempts to, drastically close or reduce the size of federal agencies, how much of that will stick. But in the story we talk about the CFPB, that's the Consumer Financial Protection Bureau. Vogt is also running the CFPB, and right now this is locked up in court. It's not clear what's going to happen. But when you talk to people who work there, I mean, nothing is happening right now. The agency has not been shuttered, but it also is clear that its ability to do stuff has been drastically reduced. And so in that sense, he's done a lot. That said, there are the questions around, how much of this is gonna stand in court, how much of it will, stand up to congressional scrutiny, a change of power, and so on. So the jury's still out there.
Well, before the jury was even out there, our team spoke to Kevin Roberts, the president of the Heritage Foundation. That was back just after President Trump won the election. This was on November 11th. He was on Balance of Power. Check out what he had to say about the opportunity that he saw then.
We think that this is the beginning of a golden era of conservative reform. I will say that because the work of Project 2025 represents the conservative movement, it would be very difficult for anybody to implement policies on education, on the border, on taxation, without at least consulting those ideas and people. That's not some arrogant or hubristic comment on our part. That's just the nature of how policymaking works.
That was Kevin Roberts, the president of the Heritage Foundation, back on November 11th, 2024, joining us on Balance of Power. Max, when you think about this term versus Trump's first term, are there ideological differences because of the influence of the Heritage Foundation, of Project 2025? Do you see differences in the way that he's making rules or the way that he's putting policy into effect? Do you see it?
For sure. Now, I think the difference is that during the last Trump presidency, Trump came in without this kind of broad base of support. It had been a closely contested nomination. There were a lot of competing factions within Trump world, and in particular, you had this kind of business faction, right? That was pushing against some of these policies that we've been talking about a lot. Whether we're talking about tariffs or various erratic behavior on the economy. And what's happened instead is you have this kind of base of committed ideologues who have spent years preparing for this moment. That's what Project 2025 was all about. It was like, the last time we had this, as they see it, this like deep state that was thwarting them. Now we're going to figure out how to actually do stuff. So what they're trying to do is avoid the kind of checks of these more moderate factions within Trump world. And Vogt is a really interesting person here because Vogt was kind of dead center of some of the biggest controversies of the last term. So Vogt was involved in holding the money up, the aid to Ukraine up. That happened through the Office of Management and Budget. Now that led to obviously an impeachment hearing and everything. As Vogt saw it, that was the deep state, trying to stop Donald Trump. So there's a lot of ways in which the guys involved with Project 2025, including Russ Vogt, have been sort of preparing for this moment for years. And I think that's one of the reasons this presidency has been so much more hardline ideologically than the previous one.
Well, that's what I find interesting. You go into some great history about his time working for Senator Phil Gramm. I mean, pull out your political history books, but Texas Republican, fiscal hawk, and you say he certainly had quite an impact on Vogt in terms of where he got that from. But I think what's really interesting is, this idea of these views on executive power. I mean, I think is what's so fascinating, right, about this second Trump term, consolidating executive power like we've never seen before. And he certainly is helping the president do this. And forgive me, we've got about 50 seconds here, Max.
Yeah, and that's certainly where these kind of libertarian Phil Gramm has had long and interesting career, but I'd say he's more of the sort of libertarian bent than somebody like Russ Vogt, and that's where the difference is, right? Whereas a lot of these deficit hawks, the old line deficit hawks, were really interested in Congress as the forcing function. For Russ Vogt, it's the executive. It's kind of clearing the field and letting Donald Trump have as much leeway as possible. Of course, critics are going to say too much leeway. We're bordering on an imperial presidency. And so that's the kind of like ideological conflict that's playing out behind the scenes, as Trump does his thing.
Yeah, it's just fascinating. A story like yours. The people that are so instrumental in shaping what this Trump term looks like. Just really amazing stuff. Max, thank you so much. Really appreciate it. Max Chafkin, columnist at Bloomberg Businessweek, co-host of the Elon Inc. podcast. Check out his story. This is on the Bloomberg, coming also in the new issue of Bloomberg Businessweek magazine. You can find it at Bloomberg.com too.
It's 4:40 on Wall Street. We do check markets all day long here at Bloomberg. Another down day for the U.S. equity market. The Dow, the S&P, NASDAQ, all declining amid heavy selling. S&P ends the Monday session at 51.58 for the S&P, a drop of 124 points, down 2.4%. Dow Industrials down 971 points, down 2.5%. NASDAQ down 415, a decline there of 2.5%. The Dow, the S&P, and NASDAQ spent much of the session down by 3% or more. 10-year at 4.41% with a 2-year currently yielding 3.76%. Gold surging $97 the ounce to $34.23. That is a record up 2.9%. And a retreat for crude oil today down 2%, $63.37 for a barrel of WTI. As for the market backdrop, given the focus on tariffs, Jeff McLean is CEO of Solidarity Wealth, and he was a guest right here on Bloomberg Business Week.
I'm both nervous but also excited long term because there's nothing fundamentally broken right now. It can be cleaned up. Now, how he's going about it's not ideal, and it's freaking out people. It's creating uncertainty, which is the buzzword like we're talking about as a firm. Uncertainty is killing the market right now.
Jeff McLean of Bloomberg Business Week Daily, and you can hear more of the conversation on the Bloomberg Business Week Daily podcast. You can download it wherever you get your podcasts. The next big event for markets, Tesla's earnings. We'll be talking about it. We'll be all over it this time tomorrow. Comes after the close of trading. Tesla shares today down another 5.75%. For on-demand news 24 hours a day, subscribe to Bloomberg News Now wherever you get your podcasts. I'm Charlie Pelleton. That is a Bloomberg Business Flash.
Hey, thanks so much for that update, Charlie. Do appreciate it. We've heard the 2024 presidential election referred to as the podcast election. And indeed, if you go back to March of 2022, the Nelk Boys, which I hadn't heard about until
I learned so much in this story.
They hosted President Trump on his first podcast. He then appeared on several conservative-friendly shows, including the ones hosted by Joe Rogan, Nathan Ross, Andrew Schultz, and Theo Vaughn.
I didn't even know there was an elk boy. Keep going.
All right. Outlets including the Wall Street Journal credited Barron Trump for his father's entree into this world. And Barron indeed advises on his demographics interests. But it's John Shahidi who actually is making the calls to arrange the appearances or finding out who can.
And if you're saying, who? Well, then maybe you should be. And this is why you want to listen, stop what you're doing, and check out what our Sarah Fryer has to say. She writes in Bloomberg Business Week about Shahidi, who's now looking pretty critical to President Trump's 2024 win. Sarah is big tech team leader for Bloomberg News. She's also the author of No Filter, the inside story of Instagram, and she's out there in our San Francisco bureau. All right, Sarah, lay it out. Who is John Shahidi?
Well, he was a manager in the music industry of folks who had pop contracts, big songs, and like Anita, Lele Pons. He worked with several DJs. And then he realized.
All right, Tim and I are just saying, it feels like you're speaking a foreign language. I'm just going to say, but go ahead. This is why
Carol's cool. She knows all these people.
No, keep going.
So this is a guy who's running with the music business, doing great, but starting to really warm up to Trump. This is during the first Trump term, and he's not getting a good response when he's talking about it. People are kind of shutting him out. He doesn't get invited to the parties he's used to getting invited to. People decide not to include him in meetings. And he realizes instead of shutting up about how much I like Trump, I'm just going to leave this industry and go for a new opportunity. And he saw podcasting become it was really emerging as a way that people were wanting to spend time online. The pandemic occurred. It was becoming even more and more like a regular consumer behavior. And he's a YouTube guy. He's worked a lot with digital creators the reason I knew him back in the day was because of his work on Vine with a lot of influencers, Instagram influencers. And so he thinks podcasts are going to go big on YouTube, and he starts partnering with a lot of those businesses. Now, meanwhile, he gets back in touch with his old friend Dana White, who's also a very close friend of Trump, who's running the Ultimate Fighting Championship, and he decides White decides that Shahidi needs to know Trump because Trump should be on these podcasts reaching young people. And so that's what happens. He really works with, through White to get to Trump and convinces Trump to go on with the Nelk Boys, with Theo Vaughn, with a bunch of these other names you listed in a way that he can appeal to a voter where they're listening casually. I mean, this is maybe somebody who might not be showing up at his rallies or might not be watching Fox News. Fox News demographic is very much aging at this point. And it's somewhere where Trump cannot be edited. He can talk about whatever he wants. And there's not going to be a time limit. These podcasts, Rogan's shows sometimes 3+ hours long. So it becomes a perfect venue for Trump. He kind of has no idea what a podcast is once he starts doing it. He starts loving the response he gets, and he sees the numbers. And he's really been embracing this group of podcasters and Shahidi and the whole UFC world as part of this new era in his presidency.
We'll talk a little bit about how Shahidi sort of went from somebody who wasn't necessarily invited to dinner or parties to somebody who's now at UFC fights with members of the administration, including the president. What sort of happened there? And also, he's been kind of accepted into the tech side of things, Sarah, which you cover. You know, he's got a direct line to, it sounds like, the folks at YouTube, at Google's YouTube.
Well, he became a kind of honored guest by the standards of Spotify, YouTube, and Meta at the inauguration. They realized what he'd done here, had this investment in podcasts. Google actually spoke to the power of podcasts on its last earnings call. They said that people really tuned in to get their news from podcasts ahead of the 2024 election. And they credit that as a really strong growth area of their YouTube business. So Shahidi was pretty early to that market. And he's also realizing that this is where all of the platforms are going to go. He knows Elon Musk. He's known Elon Musk for years. He brought Elon Musk to fights back in the day when he was representing Floyd Mayweather. He worked with Justin Bieber, Elon Musk. I have a picture of them going to a fight together in 2013. So he's known Musk for a long time. He invested in X. In the new rendition of Twitter. So this is the crowd that he hangs with. And he's really not so much a manager of these podcasters, but a business partner. And that, to him, is more foolproof, more unlikely that he will be fired with a change in the winds politically. If he's a business partner with these guys, they're selling a product together, he's merchandising for them, and they have some sort of goal that's not related to what advertisers think about content policies, which is another big factor in this, in another area where he's very aligned with Musk.
Great strategy until you have a tariff war, trade war. And those goods and merchandise maybe are produced in China. And then
there's no tariff on podcasts.
Then it's rough. Then it's rough, but it's rough on everyone at once. Yeah, I think that's a good point too. Is that podcasts are a good that just requires some guys in a room talking. In this case, it is mostly guys. I mean, this is the manosphere. This is like 98% male viewership podcasts where they're very much the fraternity demographic, and these are the people who were really encouraged by a lot of Shahidi's partners and podcast friends to go out and vote for Trump.
I mean, that's what's kind of cool. Just 30 seconds. I mean, it sounds like the Trump administration realized the access that Shahidi has, right?
And we've written in prior pieces about how the Harris campaign realized towards the end that they were going to need to make a last-ditch appeal to men, and they tried to make it work out with Rogan. They tried to make it work out with Theo Vaughn. They had a lot of rules that Trump didn't have around what they wanted to say. They couldn't get the scheduling right, and it was hard to convince people to act, right? To say, we got to do this, we got to prioritize this, because it didn't seem like that was going to be a big deal. But in the 2024 election, it really was like, are women going to show up or are men going to show up? And the men did show up.
Yeah, and you got to find them where they are at. Sarah Friar, thank you so much. Big tech team leader, Bloomberg News. Check out her book, No Filter, and check out her story from Bloomberg Business Week. You can find it on the Bloomberg and, of course, at Bloomberg.com. Also, in the upcoming new issue of Bloomberg Business Week magazine. Cool stuff.
Up next, stocks on the move.
This is Bloomberg Business Week Daily with Carol Masser and Tim Stenovec on Bloomberg Radio and Television.
All right, everybody, we're getting ready to wrap up on the Monday edition of Bloomberg Business Week. And just a reminder of how we closed on this Monday. We saw the Dow Jones Industrial Average down almost 2.4%.
Yeah, I'm looking at the screen. There's a lot of red there.
There's a lot of red.
Yeah.
And you have the S&P, I mentioned that. Yeah.
Down
NASDAQ
2.4.
Yeah, and the NASDAQ 100 down about 2.5%. But you're right.
Every single industry group lower on the day. Consumer
not
discretionary
everything-
down 2.9%.
Right? But
Not everything what?
Not everything was down. I actually had gainers.
Oh,
Phew, holding on to the green.
very lucky. We'll see what tomorrow brings.
Let's take a look at some of the stocks on the move on this Monday. Emily Grafeo is Bloomberg News cross-asset reporter, and she joins us here. Netflix.
That was one of the gainers.
Mine too.
It
Love
was one of the top performers in the S&P 500 on a day when the index itself was down more than 2%, and there weren't a lot of places to hide, even in bonds. So they reported a record profit to start the year on Thursday.
Doesn't it feel like a world away?
Yeah.
I like completely forgot.
But like no one was really paying attention because
Yeah, everyone was going on vacation.
everyone was leaving for the holiday
Yeah.
weekend. Maybe Netflix was, but traders weren't. So that stock was up higher today. Record profit to start the year. First quarter earnings rose 25%, which beat analyst estimates. And the company also said that it's seen no impact on its business from the tariffs or the market volatility that has followed. So perhaps this is a safety kind of hedge
As
play.
Bloomberg Television's Alex Steele said, it's basically you got to have your Netflix.
I was going to ask Emily
Consumer
Grafeo,
staple?
is it a consumer staple or is it a discretionary purchase? In your view?
In my view.
Yeah, in your view. And just here, I'm going to remind everybody, while you think about it, I'm going to remind everybody.
Survey.
Standard with ads is $7.99 a month.
Yeah.
Standard is $17.99 a month. Premium is $24.99 a month.
You know, you
Emily?
don't need it.
Seriously?
So I'm gonna say it's still a discretionary.
Okay.
I don't know. I mean, YouTube is free. Sometimes I feel
That's
like
where you
some
can
of
watch us,
Food
so
on the
you're
table,
right.
Yeah,
Netflix.
yeah.
Food on the table, Netflix.
When it's food on the table versus Netflix,
Okay.
Netflix feels like a
When it's
more discretionary. And there's so many
Netflix
competitors.
versus a pair of new shoes.
Oh yeah, maybe you would stick with your Netflix because if you have
Just
that
saying.
subscription already,
Yeah.
it's harder to cancel it than like buying a new pair.
Stickier.
It's
sticky.
stickier, yeah.
A little sticky.
Which actually segues into my next stock.
Okay.
You're welcome.
We're talking about canceling. Uber shares were down today as much as 5.2%. They ended the day down 3%, but it seems like a lot of the downside is coming from a lawsuit from the FTC, which alleged in a complaint today that the company charged consumers for its Uber One product without their consent and made it unreasonably burdensome to cancel the service. The agency found users can be required to navigate, get this, as many as 23 screens and take up to 32 actions just to cancel Uber One, according to the FTC statement. Now, Uber said in their response that it didn't take that many steps, but that's what the federal...
Actually, 22 screens and 31
Yeah.
stacks. Only kidding. Only kidding.
Yeah.
Only kidding.
So, I mean...
Huh.
Yeah, that stock was
Have
down.
you ever tried to do some things, though? And
Wait a second. We should
not
explain
even
what
just
Uber One is, okay?
Oh.
Okay.
So Uber One is like this subscription service
Yeah.
that you can get for Uber. You get zero delivery fees on Uber Eats orders that are eligible. It's $10 a month, maybe $96 a year, roughly. And yeah, I mean, I think Lyft has its own version of this too. I have the Lyft one because that's how you get City Bike.
Ah.
So I get a discount on Lyft rides. But anyway.
Yeah, I thought it was
Haven't tried to
interesting.
quit.
Yeah, because, well, the agency has also recently sued several other companies, including Amazon, Adobe, for making it too difficult to cancel subscriptions.
Yeah.
So I always have my eye on stuff like that because as a consumer myself, sometimes you forget and then you end up getting charged for something.
We've all been stuck in those modes, right?
Justin
You're
reminds
like,
me.
what's this charge?
Justin reminds me of the Lyft Pink is the Lyft version. That's what it's
Okay.
called. Thank you, Justin.
Justin, thank you so
Coming up big.
much.
Okay. So
Tesla.
Speaking of cars.
Yes, speaking of cars, we have a lot of nice segues today. Tesla fell 5% today. This was its third straight day of declines. Earnings are set for tomorrow. The stock is down 43% year to date, though. And there was a pretty colorful note, we can call it, over the weekend from Wedbush's Dan Ives. He does have an outperform
Who likes
rating.
to wear colorful clothes.
Yes, he's one of the best dressed sell-side analysts. But he had a note over the weekend that said Tesla's facing a code red moment as it prepares to report its earnings. And he also said that the CEO, Elon Musk, should step back from his work at Doge and refocus his attention on the car maker. And then on a more fundamental level...
But he's still bullish on
yes,
Tesla.
he's still bullish, but Tesla also reported...
Can you be bullish and then have a code red?
Ask Dan.
Yeah, I know.
He said,
I love
why
Dan. I
stay
love
bullish?
talking
It's a
with
great
him.
question. We believe Tesla, along with NVIDIA, are two of the most disruptive tech companies on the globe over the coming years.
He also said, Tesla is Musk, Musk is Tesla. Anyone thinks the brand damage Musk has inflicted is not a real thing. Spend some time speaking to car buyers in the US, Europe, Asia. You'll think differently after those discussions. We'll see what, Tesla does after the earnings, but it's heading into this earnings report down 43% year to date. Vulnerable. There's a lot of headlines. There's a lot of focus on, what is Musk's role in the company? Is he distracted with what he's doing at Doge?
Should be an interesting analyst call.
Yeah.
Earnings analyst call after the close tomorrow. Good stuff. Nice segues between them. Well done. Well done, well done. Emily Graffeo is Bloomberg News cross-asset